Hello, my name is Ashish Bhardwaj. I'm the Dean of Jindal School of Banking and Finance. Welcome to the first joint conference on societal impact of commerce, sustainability, technology, and social good, hosted by the Jindal School of Banking and Finance at OP Jindal Global University and the Albers School of Business and Economics at Seattle University in the United States. First of all, good morning to everyone who's joined us from India. It's 7:30 a.m. here. Good afternoon to everyone who joined us from the United States. And greetings to everyone who's watching this live on YouTube. Thank you very much for being with us today. There is a 12 and a half hour time difference between the Pacific Northwest and New Delhi, which gave us a rather limited time window to organize this conference and the sessions in it. We have 35 speakers, including the panelists, moderators, keynote speakers who will share insights and their views, spread over 11 exciting sessions in the 2 days of the conference. I'll take a minute. The planning for this conference, I want to share with everyone, started with a meeting in early September last year. I think it was just few days after Professor Eduardo Pinavar took over as the 22nd president of Seattle University. Among several areas of collaboration, one outcome of that meeting was the decision taken by the president of Seattle and vice chancellor of JGU to co-host a conference on a contemporary theme between the finance school at Jindal and the economics and business school of Seattle. We started brainstorming ideas 6 months ago, and here we all are inaugurating this conference today on 24th of March. I'm very excited, and I'm sure others are too. So thank you, President Eduardo Pinavar, for your thoughtful leadership, for inspiring us to make this joint event possible. You and Professor Raj Kumar will be happy to know that one of the 11 sessions is a much awaited student-centric open house for students where they'll understand and they'll be informed about a variety of opportunities that they can avail at Seattle University and at the Albers School. There are, of course, other panels where faculty members from the two institutions and other experts will engage and discuss several issues. I'm grateful to the Dean of the Albers School, Professor Joseph Phillips, who's also joined us in this session, and possibly two of the most dynamic colleagues he has at Albers, Professor Meenakshi Rishi and Professor Ajay Abraham, who've worked tirelessly in contributing ideas, curating sessions with my own colleagues, Professor Chavi Asrani and Professor Arkaja Chakravarti from the Finance School. As I said, there's a 12 and a half hour time difference. So we have about 28 minutes left for this session. I won't take too much time. I'll now invite the founding Vice Chancellor of JGU, Professor C. Raj Kumar, for his welcome address. Over to you, Raj.
Thank you, Ashish. And first of all, I would like to extend a warm welcome to all of you on behalf of Seattle University's Albers School of Business and Economics, the Jindal School of Banking and Finance, and of course, the OP Jindal Global University. The theme of this conference is very special and very contemporary in terms of its importance and relevance, the societal impact of commerce, sustainability, technology, and social good. Rarely we see business schools and schools which are focused on the study of banking and finance to be able to be providing leadership on issues relating to sustainability and social good as a larger part of how businesses have a social responsibility. I'm very delighted that through the leadership of Dean Joseph Phillips and his colleagues, Professor Meenakshi Rishi and Professor Ajay Abraham, along with my colleagues, we have been able to put together this conference at a relatively short span of time. I also want to mention that this is also an extraordinary story of how Professor Eduardo Pinavar, the president of Seattle University, all the way from his previous avatar, but also when he took over as president, made it a point to connect with OP Jindal Global University and to India. And in our earliest conversations, we decided that one of the most important ways by which we will be able to collaborate is to get faculty together and to have an academic and intellectually engaging conference that will spearhead many other possibilities of collaboration. I am particularly delighted that we are partnering with the Seattle University. As for some of you who may not be familiar with Seattle University, at least in India, Seattle University traces history all the way from 1891. It's a 130-year-old institution which has grown and evolved and in many ways reinvented itself. Its current president, President Pinalvar, has been providing leadership in number of initiatives, and we are only beginning to see the type of collaborations that we are seeing in this conference. But we hope to do many more things together across different schools of the Seattle University. I also want to mention that if there is one thing that the COVID-19 pandemic has taught all of us is for us to be able to demonstrate a deep sense of resilience and also imaginative in our approach towards governance within institutions. And this conference is an example of what we can do together, despite the fact that we have not been able to travel. I must say that we have opened up in India, and we are indeed welcoming visitors from around the world. In fact, yesterday, I think in the post-pandemic context, we hosted the leadership of the Nanyang Technological University delegation from Singapore. And the next several weeks and months, we have a series of delegations from around the world. I'm saying this to allure President Pinalvar and his colleagues, Joseph and others, to consider the possibility of visiting India and visiting OP Jindal Global University in the near future. For those of you who are in United States and at Seattle University, I will briefly spend 2-3 minutes to introduce OP Jindal Global University. OP Jindal Global University was founded as a philanthropic initiative of our founding chancellor and benefactor, Mr. Naveen Jindal, in the year 2009. I had the privilege to study and work in different institutions around the world, and sometime in the years 2007 and 6 and 7, I got to meet him and essentially persuade him to do 3 things. 1, to make a substantial financial commitment. 2nd, to do it in a not-for-profit manner. And 3rd, to ensure academic freedom and autonomy and independence to build a world-class university. We began in a very modest manner in September 2009 with only 100 students and 10 faculty members and 1 school, the Jindal Global Law School. And that in a very modest manner, we began the journey. And I must say that Eduardo and Seatal were part of the journey from the very beginning when they were teaching at Cornell. We have grown quite substantially and significantly. In the last 12 years, we have built a school every year, and now we are a multidisciplinary university with 12 different schools in law, business, international affairs, public policy, liberal arts and humanities, journalism and communication, art and architecture, banking and finance, environment and sustainability, psychology and counseling. And during the pandemic, we established 2 new schools, the Jindal School of Languages and Literature and the Jindal School of Public Health and Human Development. As you can see, the 12 different schools of JGU are at the cutting edge of liberal arts, humanities, social sciences, falling short of STEM and medicine. And that's part of our commitment to promote broadly humanities education in India. We have consistently maintained a 1:10 or less faculty student ratio. So we have now over 8,500 students at JGU. We have over 1,000 full-time faculty members. And of course, we have covered this distance in 12 years. I'm happy to report that OP Jindal Global University has been World University Rankings as India's first-ranked private university. Our law school has always been ranked as India's #1 law school, both on public and private. And we are ranked 76 in the world in the QS World Law Schools rankings as well. But beyond all of this, one of the things that we are very consciously committed to is that to be able to contribute towards knowledge creation and promotion of new and transformative ideas on critical areas of thinking, including research and collaboration. And this conference that we have gathered today is an example of what substantial and substantive partnership can yield in terms of ideating, but also contributing in significant areas. Issues relating to sustainable development and sustainability is at the heart of many things that we do within the university. But I'm very happy to see that today we are collaborating with the Seattle University's Albers School of Business and Economics on focusing on the intersection of sustainability, technology, and social good and its future for the promotion of commerce and understanding its impact on society. With those words, once again, I would like to congratulate all of you. In particular, appreciate the leadership of President Pinalwar and Dean Phillips in putting together this conference, along with my colleagues, Dean Bharadwaj and Professor Aslani and Professor Chakravarti. Thank you very much.
Thank you very much, Raj. It's my honor and my privilege to invite the president of Seattle University, a very distinguished legal scholar and institution builder, Professor Eduardo Penalvar, to deliver the presidential address. Over to you, sir.
Thank you, Dean. And Raj, great to see you. And so impressive what you have accomplished at OP Jindal Global University in a very short period of time. Watching the growth of your institution is just a source of amazement and joy to me. I just want to wish a good evening, or to my colleagues in India, good morning. It's a great pleasure and privilege to join you in kicking off this inaugural and wonderful collaboration between OP Jindal Global University, Seattle University, the Jindal School of Banking and Finance, and the Albers School of Business and Economics, with this theme of societal impact of commerce, sustainability, technology, and the social good. I, along with Raj, hope that this gathering will be just the first among many such collaborations, as together we seek to shed light on these important topics, and more importantly, as we seek to educate the leaders of tomorrow who will help us all collectively to build a sustainable and hope-filled future. Seattle University is Seattle's Jesuit university. Our roughly 7,000 students include undergraduates, graduate, and professional students enrolled in dozens of degree programs spread across several colleges, including law, business, education, engineering, computer science, nursing, and arts and sciences. And we're located in the very heart of Seattle, which is arguably the most dynamic and innovative city in the United States, and home of some of the most iconic companies in the world, including Microsoft, Amazon, Starbucks, and Costco. Not to mention more mature innovators who also have a presence in India, such as Packard and Boeing. As a Jesuit university, we are committed to an interdisciplinary model of education that goes beyond teaching our students knowledge and skills, and our aim is really to engage them as whole persons, engaging them in their minds, their bodies, and their spirits. And in pursuing our educational goals as we do and where we do, Seattle University aspires to become a place, as we say, where innovation meets humanity. And I'm just very excited about this collaboration with OP Jindal, because I see in your institution a very similar commitment to both innovation and human engagement. And I'm also excited about this collaboration because of the importance of fostering engagement between Indian universities and American universities. As constitutional democracies, our two countries share a commitment to pluralism and to free inquiry. And there's really a great deal that we can and need to learn from one another. And I'm confident that this gathering will prove to be a fruitful example of that. The topic of this virtual gathering, sustainability, technology, and the social good, could not be more important or more timely. In fact, Seattle University is currently in the midst of reimagining our undergraduate curriculum in order to ensure that our students graduate with a deeper understanding of the relationships between rapid technological change, economic and racial inequality and inequity, and our quest to build a sustainable future. And on an almost daily basis, I think we see the impacts of technology and commerce on the social good and on the future of our shared home. As both of our institutions and countries have navigated the COVID pandemic, commerce and technology and the social good have often intertwined. The pandemic itself, as we know, spread around the planet at lightning speed with the assistance of technology and global commerce. And yet it was also technology and commerce that allowed us to develop vaccines with unprecedented speed and to deploy them as quickly as we did. At the same time, global inequities in access to life-saving vaccines and therapeutic treatments have allowed new COVID variants to emerge and spread, and have forced us to reflect in new ways on the relationships between technology, commerce, and the common good. In order to develop a proper understanding of these phenomena, I think it's vital that we consider them from a global perspective. Among other reasons, I think we may perceive these relationships very differently depending on whether we view them from the perspective of Seattle or from Sonipat. And from one perspective, we might see technology destabilizing relationships and commerce, as undermining our commitments to a sustainable future or to democracy. From another, we may see that same technology or that technological dynamism as facilitating participation in the global market and commerce as lifting unprecedented numbers of people out of poverty. And so the importance of perspective, I think, is one reason that as we consider the questions that are the theme of this conference, we need to push ourselves to do that globally. Understanding our own experiences and approaches will reflect our own specific contexts, and those contexts and experiences will always be inherently incomplete. Transnational collaborations like this one, I think, constitute an essential exercise for any university that's interested in educating the leaders of tomorrow. And both Seattle University and OP Jindal Global University very much share that ambition. So I am very grateful to my friend and colleague, Vice Chancellor Kumar, for his participation and partnership in making this collaboration between our two universities possible. And I would also just like to thank our colleagues at OP Jindal University and the Jindal School of Banking and Finance for their efforts, Professor Astana and Professor Chakrabarty and Dean Bharadwaj. Here in Seattle, I'd just like to extend my thanks to Dean Phillips and the faculty members in Seattle University's Albers School of Business and Economics, particularly Professors Rishi and Abraham, who helped to organize this event on behalf of Seattle University. And I'm grateful to all the Albers faculty who will be serving as panelists. As I said before, I very much hope this collaboration is just the first of many still to come. I will certainly be taking up Vice Chancellor Kumar's invitation to visit, and I very much look forward to in-person engagements between our two institutions, both here in Seattle and also in Sonipat, and to broadening our collaborations to extend beyond our business schools and into all the other areas where our universities overlap. In the meantime, I hope that you all have a very wonderful and fruitful dialogue over the next 2 days. Thank you.
Thank you very much, President Penalwar. Very insightful words. We've taken a note of some of the things you've said, and we are going to be discussing them in subsequent meetings that we plan to host and conduct very soon. With that, let me now invite the Dean of the Albers School of Business and Economics, Professor Joseph Phillips, to deliver his Dean's remarks. Over to you, Joe.
Thank you so much, Dean Bharadwaj. So good morning and good evening, as the case may be. I want to say that the Albers School and Seattle University are delighted to partner with Jindal Global University in presenting this conference on the social impact of commerce, with a focus on the three critical issues of sustainability, technology, and social good. It will hopefully be among the first of many instances of collaboration between our two universities. We want to thank our colleagues at Jindal, especially Professors Chavi Asrani and Arkaja Chakravarti, for their excellent work in putting this conference together. It has been a privilege to partner with all of you, of course. I also want to thank the key organizers at our end, Professors Ajay Abraham and Meena Rishi. They have worked very hard to create an outstanding program for our conference attendees, and as always have served as outstanding ambassadors for our university. This conference is very timely given the changes sweeping over the business sector and business schools. A growing number of business organizations are acknowledging that their success cannot be tied to shareholder primacy, but that a successful business must respond to multiple stakeholder groups: employees, customers, partners, the community it operates in, not just owners. In the US, this is best exemplified by the 2019 statement of the Business Roundtable, acknowledging that their success is not all about profitability. Likewise, within business education, we need look no further than AACSB, the premier business school global accreditation body, an organization that both Seattle University and the Jindal Global University are aligned with. The most recent accreditation standards, released in 2020, now require business schools to think strategically about their societal impact and to have a societal impact plan that is both strategic and tied to the mission of the school. Impact should extend across the curriculum, across faculty scholarship, and the initiatives and activities of the school. AACSB even suggests that impact be measured against the United Nations 17 Sustainable Development Goals, which include such things as gender equity, income inequality, climate change, and so on. Turning to the exceptional program that has been devised for this conference, we see that experts have been convened around important issues such as income and wealth inequality in the US and India, the need to make financial inclusion a priority in the US, how e-commerce can facilitate social justice in India, or even the need for more sustainable business practices from the business sector in both countries, among other topics. Each of these issues can be tied to at least one of the 17 UN Sustainable Development Goals mentioned earlier. So they are in alignment with both the directions of business education and changes sweeping over the business sector. So with that, I want to again thank all of our participants and especially those at Jindal Global University and Seattle U who have planned and arranged this important conference. So back to you, Ashish.
Thank you very much, Dean Phillips. We are on time. We have 8 minutes left. I only need about 2 or 3 out of those 8 to say a few words. I don't want to talk too much about the sessions because Joe has shared with all of us how relevant each of the themes of the panel discussions are. I want to highlight something because I know I've been told by the IT just now that the students and large number of participants are not just watching this on YouTube, but also on the Facebook page of JGU. So in case any participant, any viewer feels that he or she is better off watching it on Facebook and sharing it, feel free to do that. The signing MOUs is fine. It's really the easy part. And we'll surely do that and renew them. The real partnerships are the ones, as President Pinawar said, that are really bottom up. These are the ones that sustain. These are the ones that scale up over time. These are the ones that grow because they are built on the foundation of individual synergies and common areas of interest and passion. This is also a time, as other speakers have touched on, when all of us in universities, in different areas of higher education, be it students, faculty, scholars, we understand that our strength as one world, as one people, will be inextricably linked, tied to the success that we demonstrate in bringing people together, people from all backgrounds, nationalities, choices, and I must add all disciplines. Although JGU is an entirely social sciences, arts, and humanities oriented young university, there are a diverse set of areas outside the social sciences and humanities that our faculty members and by extension students engage with, including technology, including digital transformation, including scientific research and the process and the pedagogy for it. And this is the only way into problem solving together collectively as we face the future. And in this context, we are very happy that we were able to bring in people to talk about sustainability, to talk about new directions in finance, something which is completely transforming how we understand business, do business, how we receive it as consumers, especially in India or in South Asia. It's also very important for us to understand how the smaller firms, the smaller businesses, and how households and consumers at the relatively lower threshold of income and wealth are impacted by pandemic, and what we can do going forward in bringing them in the benefits that this digital transformation and digitization of finance is going to bring about in all parts of the world. We have a very exciting keynote address, which is at noon. It's about 4 hours from now, by a very distinguished expert from Niti Aayog, which is the leading think tank of the government of India. He's the head of the economics and finance department, and he's going to be telling us where the Indian economy stands right now in March 2022, in the aftermath of a very brutal health and financial crisis that the entire world has witnessed. We are looking forward to it. As I said, student open house is something which a large number of students and faculty members, including our international office, are very much looking forward to attending. I'm so glad that both Ajay and Meena have volunteered to take up questions. We've already received a long list of questions, which basically demonstrates the excitement that students of Jindal, of OP Jindal Global University have across schools and disciplines, right from business school, which is also, by the way, undergoing their AACSB accreditation process as we speak. Also the law school, which has gained reputation in the last few years, and the 10 other schools. There is a lot of interest among students to explore options in the Pacific Northwest of the United States. They are very excited about Seattle University for many reasons that the president of the university has already shared with us. So I'm looking forward to discussing and taking forward new initiatives, new ideas for collaborations, not just with students, but also with faculty. There's a lot that we can accomplish if we can bring together faculty members. We can start with our two schools and have smaller focus groups where they can discuss and share ideas, perhaps work on papers together, maybe do a follow-up conference. I hope there is a follow-up conference same time next year. And this would be a wonderful takeoff, I believe, of our partnership. With these words, we've come to the end of the inaugural session, but I know we have some more time left. Thank you everyone for joining us in inaugurating this conference. It could not have been done in any better manner. Unless there are anyone else who would like to say any more words, I would like to close this session, the inaugural session, and after 10 minutes, we are going to start our next session, which is on new directions in finance.
Very good morning and good afternoon to everyone. Good evening to some of the folks in the US. Uh, I'm super excited to be chairing the very first panel discussion that we have planned for this joint conference between OP Jindal Global University and Seattle University. The theme is New Directions in Finance, the Good, the Bad, and the Ugly. You may be wondering why this theme and why the name. So when the organizers of JSBF for the Jindal School of Banking and Finance and the Albers School of Business first approached me to moderate a panel on fintech, I was just wondering how I'm going to encapsulate this big, wide field of fintech in an hour, right? So that time I was watching the Western classic, The Good, the Bad, and the Ugly, the Sergio Leone classic, played by Clint Eastwood, Lee Van Cleef, and Eli Wallach. And I said, oh, fits perfectly well because fintech, while it has been touted to be the savior of everything bad in the world, there is an element of caution and risk as well. So this fits perfectly well. My name is Ram Ramachandran, and I'm a senior faculty at the Jindal School of Banking and Finance. I'm excited to be moderating the session today with individuals who have distinguished themselves in their fields. I promise you that all three of them have nothing to do with the good, the bad, and the ugly. They're all, excellent and honorable individuals, and they are going to be, discussing about the new directions in finance. I have Kathy Kao, she's an associate professor at the Albers School of Business and Economics at the Seattle University. She initiated the class on fintech at the graduate level a few years back, so she has been a leader in the space of spreading the world of fintech and blockchain to the students at Seattle University. But she has also been, involved in other areas of corporate finance and investments. In fact, she has been in the industry prior to being an academician. And we are second. We have Mr. Rishabh Sinha. He's legal head of Flowbiz. Flowbiz is a fintech startup company. It's a neobank. And again, he's a lawyer by profession, and he brings in a very different flavor of what fintech is doing to both in Indian context as well as from a regulatory and risk perspective and controls standpoint. Finally, we have Shaojian Zhang, and I'm not sure if he has joined so far, and he's, I've known him for the past 6-7 years. I met him in Washington, D.C., and he has been on several blockchain advisory boards, and he has been founder of a FinTech for Good organization in the past, and he is currently the principal manager at Amazon Web Services, and he's primarily focusing on financial risk and economic development. He used to join us from Virginia on the East Coast, so it's very late for him, and we are just still waiting for him to join us. So hopefully he can join us shortly. So with that said, I just wanted to provide a little bit of context to what this panel is about. New direction in finance has predominantly been driven by fintech and related technologies, blockchain as an example, right? And it has become the epicenter of everything related to payments and lending and crowdfunding and other types of financial transactions. So over the past several years or decades, I would say, since probably the most prominently is around 2005, the whole revolution and use of fintech started with in Kenya, interestingly. When Safari.com, which is a telecom company, decided that they wanted to venture into the world of quote-unquote finance. The average Kenyan used to spend a lot more money going to a branch or a bank branch to take money or conduct financial transactions. So the Safari, the telecom operator, their chief, decided that there may be a better way to handle these kind of problems that the common man faces. So since that time, the mobile payments and the transactions that happens through M-Pesa and other technologies, it has completely transformed the Kenyan and the sub-Saharan region. Most of them right now they believe their mobile phones are a lot more important to them than the actual cash, right? So again, that kind of revolution has not just happened in sub-Saharan and the African countries, but across the globe. So whether it is in the Western Europe, or whether it is in the US, or in the South Asian market, it is taken a significant role in terms of how the post millennials are interacting with financial institutions and such. So it looks like we have been over the last 15 years we have been standing on the beach and the sand keeps moving from under our feet, and the way we have been using and spending and borrowing money and moving money and conducting transactions has changed, and it's continuing to change. So I was reading the book on Bold: How to Go Big, Create Wealth, and Impact the World by Peter Diamandis and Stephen Kotler. They talked about the 6D stages of disruptive technology, from digitization, disruption, demonetization, dematerialization, democratization. Basically, they are positing that technology adoptions follow a similar and predictable pattern. I feel that some of these stages are more happening in a more concurrent fashion, especially when it relates to fintech and other strategic technologies. Because it is not one follows the other. It is a matter of while the democratization is happening, there is also a demonetization as it relates to information or money or others, and that happens on in a parallel way, and one leads to the other as well. So when we talk about these emerging technologies, we also need to discuss as to how some of these decentralized finance and blockchain and some of the new terminologies and lexicons that keep adding to our financial lingo on a day-to-day basis, whether it is around digital bank, virtual assets, NFTs. These are terminologies that we have come to hear more about it, probably understand a little less, but it is becoming more and more prevalent in our day-to-day life. So the question to be asked is this all good? And are we at the threshold of something that is going to completely transform society? And is this all making a positive impact or not? Is it being done equitably? There are more than, I think, 1.7 billion unbanked adults in the world, and these financial inclusion, though, has been on the rise. It has been somewhat uneven and patchy across the world, right? Some countries it has been adopted and accepted a lot more, but in other places it has been a little less so. So even a new World Bank report that came out, they talked about the fact that the financial services find that men obviously remain more likely than women to have an account. So in the context of the theme of this conference, when we're talking about sustainability and meeting those SDG goals, we need to think about whether these the finance and the transformation that's happening in the world of finance, whether it is being equitable across the spectrum, and whether it is advancing these sustainable development goals. So there are how do we enable and encourage the institutions to do that? While that is happening, we also need to look at, purely from a technological and innovation standpoint, whether that is, causing other types of issues, whether it is related to environmental concerns, whether it is related to, making sure that the institutions themselves are able to operate and, make it more meaningful, right? For countries to grow, the economy to grow. And some of the traditional banks these days are obviously facing the heat from fintech startup companies, and because the entire model that they were they started out with is kind of shaky right now, because their net margins are being questioned. So are they going to cannibalize their own market by partnering either with fintech firms, or whether they are going to start their own fintech companies? So there are these broader questions, and that is some of the ugly faces of these whole aspects of new directions in finance. The cryptocurrency world has also shaken the world in many ways. And now countries and central banks are now looking at how to counter that so that they don't lose the, quote unquote, the control and the governance of how their own currencies are being used and leveraged. So the central bank digital currencies are coming into play. And so is that now kind of inhibiting innovation as well. So there are a lot of different challenges and issues that we can talk about. So, but I wanted to break it down into again the good, the bad, and the ugly, and then discuss that in a little more detail. So, with that said, I wanted to first talk about the business model changes itself, right, and how that is happening and why that is, how that is being dealt by with, traditional banks and thoughts on that. So let me turn over to Kathy, and if you wanted to make any opening remarks, that would be great. But if you can talk about the, the ongoing business model changes that are happening and how that is impacting the traditional bank from your perspective, Kathy.
Thank you, Ram. Thank you for the beautiful, wonderful opening remark at the very beginning. So in terms of the business model changes, we know that fintech brings disruptions to the traditional financial services. The bank should treat the fintech innovations as the opportunities instead of merely the threats that allows the banks to enable a more diversified pipeline of investments to support a richer innovation ecosystem. Financial institutions, in my view, must collaborate to identify top priorities for transformations, solve for the regulatory complexity. As consumers' demands continues to grow, it will become increasingly difficult for financial institutions to cater to all the needs of the consumers. In the future, financial institutions should consider what portion of their business they would like to retain and focus on, and what partnership can deliver better value to the customers. By exploring options to externalize a large number of redundant processes across institutions, firms will benefit from efficiency gains and increased sophistications. However, banks must consider what capacities they should continue to focus on as a source of the competitive advantage. Financial institutions are engaging with fintech startups either as investors or through strategic partnerships. Banks have invested a wide range of fintech spaces such as payments and settlements, capital markets, data analytics, real estate, wealth management, and blockchain, of course. For example, Goldman Sachs and Citigroup are the most active investors. Goldman Sachs Markets offers savings accounts and personal loans. This basically is a departure from the investment bank, which did not have a consumer arm until recently. Goldman Sachs has focused its fintech investment on real estate, data analytics, and payments and settlements. So betting on this subcategory, aligns with Goldman Sachs' digital strategy of scaling its consumer offering markets. Similarly, Citi has backed blockchain, capital markets, and payment settlement startups. Generally, this investment fits into the bank's larger strategy of building an open banking infrastructure. Last year in October, Citi announced that it can facilitate digital bill payments for both institutional billers and their customers via so-called request for payment (RTP) network, the real-time payment system from the clearinghouse. So with that capacity, Citi's institutional clients in the US can send electronic bills via RTP network to retail account holders at Citi or other participating banks. JP Morgan, meanwhile, remains focused on strengthening its capital market solutions and scaling its payments business. Capital markets, including startups that are augmenting or replacing security issuance, trading, clearance, and operations. Banks that have invested in capital markets startups, including JP Morgan, Chase and Corporation, Citigroup, Morgan Stanley, Goldman Sachs, and Bank of America, so on and so forth. So, yeah.
That is quite insightful in terms of what's happening at some of the Wall Street firms, in terms of how they are, perceptibly changing their business model to meet the new, demands, right, of the consumers. So I'll come back to some of those points that you mentioned, especially relating to the payments and the what JP Morgan is doing. But before that, I wanted to kind of pick up on the same theme of this digital transformation and whether it is actually doing good. And so, Rishabh, from your perspective, you are part of the institution that is doing the kind of really pushing the traditional banks in India. And so, where do you see this transformation happening? And what is the state of digital transformation in India from that perspective? And where do you see the business models being kind of disrupted by the traditional state banks and the HDFC banks, if you will? And so what's your take on that?
Thank you so much, Ram, for having me here. And wonderful points by both Kathy and you in your opening remarks in summarizing where exactly on a global scale, fintech is moving. I think in an Indian perspective, if I take a very macro view and a historical view, a lot of this digital transformation is something which has been taking place for the past 2 decades at its own pace, and there is credit to be given to the central government for pushing this with a hard hand. So if you look at it from the 2000s. We had a general overhauling a lot of payment systems which were really very old at that given point of time. So proliferation almost forcefully of net banking, of an overhaul of payment systems, which form the fundamental basis of a lot of the financial systems in India, like NEFT and RTGS. These were some of the great things that happened in the 2010s, and it was on the basis of this foundation that the 2010s, which saw the massive growth in fintech and the arrival of various disruptors in the form of private market players also happened. So in the 2010s, I think 2 or 3 very important things happened. So the first thing is that we had certain new kind of payment products come in. So something like UPI, which is a very mobile first thing. Mobile wallets, PPIs, which, like you mentioned, was first in some form pioneered in Kenya. It came in a really big way in India and allowed collection of payments by retailers and making payments by the general populace. All of this was fueled by, again, a key government intervention of being able to do a lot of digital onboarding. A lot of onboarding of financial customers digitally by using Aadhaar enabled KYC procedures, which took almost everything to happen online. Now, because of some of these supply side pushes, both from the government and certain other factors like demonetization, the increasing internet penetration in India, all of this created this environment, and with the final push with COVID-19, adoption of a lot of these fintech models and people becoming comfortable with using their mobile phones and the internet and the computer generally to do financial transactions has really gone up. What this has done, if I talk about, if I come to your last part of the question regarding changes in business models, I think what this has done is this has fundamentally changed the expectations of a consumer that they had from their bank or financial service provider. What this has done is that it has led a behavioral change in people where not just millennials and post-millennials, but even some the earlier, some of the more older folks in this comparison are expecting more and more things to happen online. Now, what this is doing is that it is putting a lot of strain on all areas of how financial sectors were traditionally perceived. So, be it opening of a bank account, be it having multiple forms of receiving or sending payments. A lot of this, there is a lot of demand side pressure from consumers to make this simpler. And if we see from a business model perspective, there are so many players out there which are attacking each and every part of this business, which was traditionally considered to be a financial services domain. So let me, let's say if we talk about something as simple as collection of payments, there are, what started with Paytm QR codes being available at every counter to now these Bharat Pay QR codes. What this did was that now suddenly a person, a private player, has insight into how many small businesses, they have an insight into what kind of cash flow they are, and therefore a credit gap which existed in let's say in the SME sector, where banks couldn't underwrite small loans to these individuals, which was something traditional finance was not able to solve. Suddenly, by having these kind of players, which what essentially they did was just allow payment collection through a particular app, this has opened a new vista where new income, new players are bringing in innovative financial products built on some very simple innovations. And a lot of these simple innovations are coming from outside players because it was not something which traditional, the incumbents in the financial services sector, they did not foresee it, or they did not see the need for it. Now, again, moving, one step back again and looking at this as a general trend. I think, we can see that banks are seeing this, and they are seeing, how, like Kathy also mentioned earlier, consumer demands in this front are rising, and they are responding also. Having a almost branchless, completely online version of banking has also taken off in India. And you could say, the Kotak 811 or the SBI Yonos kind of platforms, which are now almost every other bank is coming out with. These are, some of the very interesting things that are happening. So you can say that there has been this sort of a ping pong interplay match happening between fintechs and traditional finance in India. And it is being moderated by the central government in seeing that, keep trying to keep both players in check. So if a Paytm comes and allows some kind of bank, payment collection, then the banks respond with something else on their end, and this thing goes on. So I think ultimately it's a very healthy sign for the Indian consumer. Of course, there are challenges, which we can get into later, but
No, that's put very eloquently, Rishabh, in terms of how the transformation is happening, right in front of our existence right now in terms of use of money and flow of money. So you talked about the payments, which is kind of what consumers are most used to, and that has definitely had a significant impact. So I wanted to come back to Kathy on this point. You mentioned about J.P. Morgan Chase and Goldman Sachs and Citi in your initial remarks. And while payments and lending has become the kind of the mainstay of fintech revolution, while crowdfunding and wealth management, they are also part of the functionalities that are provided with using some of the newer technologies. One of the interesting things is that if you look at the largest bank in the world, right, the ICBC Bank in the construction bank China, what's happening is that now this new entity, Ant Financial in China, which does not have any branches, right, and they have over 200 billion assets under management. They operate completely online, and they are expected to even then they have become even bigger than the JP Mortgage, US Treasury bond funds, right? So it's become that big. and they are expected to grow even beyond what I think they're at some $500 billion or something like that, and they're supposed to grow even beyond ICBC in the years to come. So that kind of and a lot of that is driven by what consumers want, and especially around banking transactions and payments and lending. And then given your focus on payments and lending, is the growth, Kathy, from a lending perspective, is that really driving the changes technologically, and how is that? And is that, from a social investment standpoint, is that a good thing? And so if you can just comment on that. So then I want to talk about some of the risks and challenges that Rishabh mentioned as well.
Thank you. Thank you, Ram. So I think the lending definitely promotes the financial inclusion and provide some benefits and welfare to the society. And especially, the lending using blockchain technology grow very fast. Blockchain technology's value comes from transparency, security, consensus, automation, and so on. Blockchain allows state-based communication and peer-to-peer transactions without having to process the transaction through intermediary or a central point of control. Lenders could benefit from these features in underwriting or origination of loans. These processes are often fragmented and complicated with the middleman. Assigning non-essential processes to the blockchain could reduce the operation costs. Fintech lending also benefits from the application of AI and alternative data in credit scoring and loan monitoring. So provide more services to the previously unbanked group. Fintech lending currently constitutes, however, still a small share of overall lending in the US. But fintech growth rate outpaced the lending growth rate for the entire market. According to a recent study by Berg, Foster, and Puri in 2021, in the mortgage market, where fintech lending has gained a significant presence, the fintech market share of new lending, including refinances, reached a new high of about 14% in 2020. Going forward, the importance of fintech lending for capital allocation, financial stability, and macroeconomic outcomes is likely to depend on whether fintech lenders continue to serve specialized fields, or whether they are able to gain a significant presence in major parts of the US lending markets aside from residential mortgages. Fintech lending has gained double digits market share in the mortgage market. Fintech lending growth rates are particularly high in the buy now, pay later market. While marketplace consumer lending was importantly earlier on, but has not displayed much growth in recent years. Marketplace lending plays a relatively minor role in the fintech lending space. Lending Club and Prosper, for example, have not expanded lending volumes over the past 5 years. Bailyap and Dave Denko in 2019, they show that in recent years, over 90% of the loans on Prosper are done by institutions. Lending Club has recently shut down its platform for retail investors. A study by Ziegler et al. In 2021 shows that fintech business lending expanded 43% per annum, and now stands at about $31 billion in 2020. the majority of the fintech lending is not provided by marketplace lenders, but by balance sheet lenders, where the platform entity provides a loan directly to a consumer or business borrower. The loan is on the platform's book or balance sheet. The key competitive advantage of fintech lenders are faster processing time and an improved user experience. On the one hand, fintech lender can thus provide loans more flexibly with credit demand changes. For example, buy now, pay later firm have implemented instant loans requiring just a name and email address. And using this together with the applicant's digital footprints collected from the applicant's online behavior to make a credit decision. On the other hand, the ability to borrow without any effort requires, without any efforts, might be introducing or motivating consumers to overborrow, especially when it comes to unsecured loans, such as buy now, pay later. And Di Mangio and Yao in 2021, their study compares default rates between fintech and bank borrowers using unsecured personal loans. And they find that fintech borrowers become more likely default at substantially higher rates. Fintech lenders can improve screening and monitoring using non-traditional data sources, alternative data, and new methodologies such as machine learning. However, evidence on the extent to which the growth in fintech lending has been driven by a significant competitive advantage over banks in terms of the screening and monitoring is limited. Thank you, Ram.
Thanks, Kathy. I think that's excellent lead-in to what I wanted to talk about in terms of challenges. But this whole, the BNPL industry is definitely caught on the imagination. It's, I think it's expected to be about a 600 or 700 billion industry in the US alone. But one of the intelligence report that I was reading talked about the fact that these, BNPL in the industry, the fastest growth is actually not happening in North America or in Western Europe. It's actually happening in India and China and South Korea. That's where this is happening. And so what the interesting thing is that it is it's definitely going to bring a lot of pressure on the traditional credit card industry as well, right? Because they are going to get out of the credit cards and use the BNPL. And now, I think even companies like Amazon and Apple are trying to get into the BNPL space, and that's going to put tremendous pressure on the traditional financial industry, whether the credit card industry or the banks. Very interestingly. But the thing that you mentioned around the default rate, I think that kind of brings us to the not so good part of the fintech industry. And is this promulgation of lending and quote unquote easy money that used to happen before the 2008 financial crisis, right? Whether that is going to create put a little different twist, maybe the euphoria of use of fintech and such right now, and access to easy money, whether that's going to have some impact, and what kind of challenges that you think we will be facing. So I want to start with Rishabh here in terms of trying to understand where do you see the aspects around the roadblocks and the challenges that you see with the direction that the finance and financial institutions are facing right now, both with the pressure from the consumers as well as from the traditional institutions. So there is like a triangulation of different forces coming to play. So what do you think are the challenges and the roadblocks and some of the bad sides of the fintech growth, if you will?
Sure, Ram. So, building on what Kathy mentioned, especially about the exuberance of the BNPL sector, I was reading recently that in 2021 in India, UPI growth rate used to be something which was always touted as, the most amazing thing in fintech. But I think what is an unknown fact, these are not a well publicized fact, is that BNPL actually outstripped UPI growth by by a huge margin. I read an estimate that it had 600% growth in just 1 year, which is massive. And I do agree that there is a lot of exuberance in who this money is being lent to. And Kathy is absolutely right that there needs to be a more moderated approach towards lending. But I think there's also another a business strategy viewpoint which also has to be seen over here. BNPL and players who are offering BNPL are new entrants in an industry, and I think a lot of the money that is being spent today is money which is being spent towards garnering market share. Time will tell that if they are not able to make their books right, it is in their own interest to be not lending fast and loose, because cost of capital remains the same for everyone. A lot of these companies today are, I think we can rationalize what they are doing by saying that it is for the purpose of gaining market share. And I do feel that, if this goes on unchecked for a fair amount of time, especially, in certain very critical areas, for instance, many new fintech startups came up in the past couple of years, lending to students, who have no credit history, no, means of having any income. And these products still exist in the past, but they were very carefully used by traditional financial, services providers. Similarly, payday loans, which were a huge thing in the US, but not so much in India. Similarly, gold loans. These are all in some an idea old products, but with a fintech vigor, I think a lot is happening. If this continues for a huge period of time, I think we might see a debt problem, a consumer debt problem spiral. But what I suspect is that the exuberance, the investor money, the equity money, or this is not going to last as long. So I see this as a more temporary problem and more linked towards gaining more and more market share. A lot of the basis, for underwriting some of these loans, especially where you're not using traditional data sources, this is in concept a new idea. Like, for instance, how Kathy was mentioning it, a lot of people are using alternative data sources like your digital footprint to decide whether. So I think default rates on that, it's still some years into the making to see exactly how successful that is. And I think bankers and fintech entrepreneurs are on opposite sides, with bankers, waiting to say, I told you so, and fintech entrepreneurs on the other side saying that, hey, there's another way to do this. But having said this, I think in general, both if we want to say about, if you say about the bad side of fintech, or, what are the roadblocks in its proliferation, I think there are a couple of, at least from the Indian experience, I think reliability is the big term which gets spoken about at every level, and at every meeting of anyone who's interested in this. When I say reliability, there's two things. One is from an institutional perspective, and the other is from a technological perspective. So when I say from an institutional perspective, most fintechs do not, at least in India, fall under any kind of license or oversight regime under anyone, right? They are mostly beholden to non-specific regulation, like, for example, consumer regulation, or, general information technology rules. Kind of a situation, as against traditional BFSI, which have much stricter requirements in their own corporate governance, in how they in the process of taking out any new financial products. A lot of the scrutiny is not there currently, which affects and which is going to affect consumer preference going forward. So right now, there may be a very attractive product, but if anybody wants to, as a consumer, invest deeply in some of these areas, this institutional reliability problem needs to be solved. We don't want a situation where, let's say you are using an investment platform and, this player is there today, that player is not there today. This is especially endemic in the blockchain industry, where, exchanges pop up overnight. Some kind of new protocol comes, a token sale happens, and next day that person is.
So, Rishabh, just hold on to the thought for a second. I wanted to touch on that blockchain and the cryptos in a moment, and I know we have to start wrapping things up and open it up for questions, right? So I want to touch on the last part of the segment, which is the ugly part of fintech and blockchain, and you started kind of taking us there, if you will. So the great segue. In terms of the blockchain has been touted as the next internet, and there is a lot of enthusiasm, and from a technological innovation, there is. I mean, I understand as a technologist, I see the potential, I see what it can do. But it has been so intertwined with the cryptos, right, and the cryptocurrency and the mining market, if you will. And so there is the dark side of these, how blockchain is being leveraged and used, both as a crypto platform as well as in terms of the general fintech platform. And they become indistinguishable at some point in time. And so the question then is, I'll start with Kathy here again, very briefly, and just keep your remarks to a minute or two. In terms of where do you think are the challenges as it relates to the use of blockchain in the future, right? And what is it that we should be wary of, and what the impact, both from an environmental standpoint and otherwise, what do you think is actually hitting the consumers that we are not completely aware of? So if you can just elaborate on that, and then Rishabh, please pick it up. The thought process that you had in terms of from an ESG standpoint and from a regulatory standpoint, if you can touch on that. So Kathy, over to you, and then immediately after that, Rishabh.
Sure. I can just talk about 1 minute about the challenge. So Risha already mentioned a lot the potential risk, especially in Indian market. Although fintech or blockchain, promote the financial inclusion and business sustainability, but it also have, its own challenges. Despite the, the benefits of fintech, the risks in technology, including like fraud, issues of competition, data leakage, unprotected consumer funds number, among all of this. Aggressive fintech lending, we talk about as well, may lead to high default rate, therefore affect the stability of the entire financial markets. The application of AI and the use of the alternative data may intensify the existing bias and hurt individuals for being members of particular communities or families, or for their affiliation with certain race, political, religions, and other groups. Responsible, financial innovations require balancing the opportunities and innovation with safeguard to protect consumers and promote the financial stability. And blockchain quickly has its own challenges, such as the lack of the standardization of blockchain network designs across business, the need to improve the intercooperation among multiple business, the lack of liquidity in asset transactions, and so on. So it's important to not only know about the existing blockchain technology, but also understand the potential impact of blockchain to the business, and also potential blockchain applications as well. Yeah.
Okay, thank you. Rishabh, very quickly, we are kind of running short on time here, so if you can quickly touch on the dark side of blockchain, and because you just started touching on that, and
yes.
from the ESG standpoint.
So Ram, I think there is a saying with that the proof of the pie is in the eating of it. I think similarly in blockchain, the proof of the platform is in the protocol. I think the biggest difficulty in any blockchain protocol is that the number of people who can certify the protocol's validity, or when we say that it is transparent, how well it actually functions it's difficult for the average person on the street, or even the higher than average person on the street, to actually assess these blockchain protocols with as much ease as they would do any other financial product, or anything else in the financial services industry. The financial service industry has a lot of other external players going on and certifying various things, certifying, institutions, products, all of which lacks currently in, any blockchain product that we have. There are very few and players around, but I think that's one big challenge which needs to be addressed every day. We see some kind of ICO token offering, something of this. And I think if this is not reined in, it's going to be bad for Web 3.0 in terms of, consumer experience. That's number one. I think generally speaking about in terms of fintech, from an ESG perspective, I think the one point that I just want to make, is that there is a huge opportunity, a big data opportunity, because what the data footprint of financial services players in the past had been pretty limited in terms of, looking at their bank accounts and their transactions. Right now, today's fintech players who are offering various products, they have a lot more insight into consumer behavior and, what kind of activities a person is doing. Their financial data is linked to other forms of data. And from a policy perspective, from a financial inclusion perspective, from an SDG 7 and 13 perspective, there's so much that can be done to promote things like SDG 7 and 13. So I think fintech in general can presents a great opportunity in promoting ESG standards, and using fintech as a tool to promote ESG standards in other industries as well.
Okay, thank you. I think you wanted to wrap it up on a positive note, which is great. But clearly there is the dark side to it, and especially people who have been involved in the cryptocurrency. Unfortunately, Shawchen could not join. I don't know what the challenge was. He has been dealing with from a central bank digital currency standpoint. I see there are two primary things. One is an obvious one as it relates to the fact that these large data farms and mining farms are now consuming so much power and electricity, and so there is a whole issue around whether that's the right approach and what is it that can be done. So that's a little more obvious, but I think there is also the other ugly side of fintech and use of blockchain is the fact that there is a lot more focus in terms of curtailing innovation in some ways, because now the institutions, the traditional institutions, as well as government agencies, and so they don't want to cede control, and so they want to. This is supposed to be a completely decentralized platform, and now you are trying to bring in more centralization and control. So it's kind of fighting tooth and nail as to where is the right balance. And so clearly, if you are trying to partner with fintech firms and partner with some of the newer technologies that's got a different take on it, but otherwise it is a matter of ensuring that this doesn't go down a rabbit hole that we can't get out of, right? So with that said, I wanted to this is a very interesting discussion. We can continue this, but I want to open it up for questions to the audience if there are any, because we have another 10 minutes, I think, Chavi, to close this session out. So from the audience, if there are any questions, either through Facebook Live or YouTube or through this Zoom window, if you guys have questions, please let me know. Okay, so one of the first things that I had a question on, Kathy, you are my, as an academician and as a professor, there's been a lot of interest, and I see that at OP Jindal Global University in terms of, the young 17, 18, 20-year-old, wanting to learn more about blockchain and cryptos and such. So from your standpoint, why is it important to learn about these technologies for either business graduates or other social science graduates to learn about these new the paradigm shift that is happening in the financial institutions purely from a technological advancement perspective? So if you can just, from your perspective, from when you are talking to your students and when you're what you're hearing from them, if you can just provide some perspective, and then we'll go to other questions.
Thank you, Ram. Great question. I like the question. I want to convince everyone to take, fintech courses or blockchain courses. Among the fintech innovations, blockchain has thoroughly disrupted our accepted way of doing business. Blockchain is a shared, immutable ledger that facilitates the process of recording transactions and tracking assets in a business network. It is the underlying digital foundation that supports the applications such as Bitcoin. Virtually anything of value can be tracked and traded on a blockchain network, reducing risk and cutting costs for all involved. The reason why financial industry is fascinated by blockchain technology is that the characteristics of the blockchain allow people to build trust faster and more efficiently, and have the potential to change the financial infrastructure. So we can think of blockchain as the operation system, such as Microsoft Windows or Mac OS. The Bitcoin is one of the many applications that can run on that operation system. And you mentioned about the DeFi, right? Decentralized finance. It's a blockchain-based financial infrastructure that has recently gained lots of traction. The term refers to an open, permissionless, and highly interoperable protocol built on the public smart contract platforms. So I think we also mentioned blockchain has its own challenges. So it's very important for business students to understand the blockchain's impact across industries, including its risks as well. And as future business leaders, entrepreneurs, investors, and business stakeholders, students need to master the foundations, fundamentals of the blockchain technology, and also, need to not only become familiar with existing blockchain application, including cryptocurrencies and smart contracts, but also be able to explore potential blockchain applications. That's my view. Thank you.
Thanks, Kathy. There is another question, and very topical. And when you're looking at the split screen on television these days, there is always this. We see what's going on in Ukraine and Russia, and so. Clearly, that brings up, begs the question, and we have a question from our dean: is what is the impact going to be, if at all, on the evolution of distributed ledger technologies or cryptocurrencies and such? Whether this war is going to have any impact at all or not. So let me first ask, Rishabh, when you put on a legal hat and whether from a regulatory standpoint or otherwise, do you think there is going to be an impact of this war on the progression of the use and evolution of cryptos and blockchain or DLT more broadly?
Yeah. I think, Ram, it's going to have a huge impact. And I think it is soon going to look like a foregone conclusion. I think as we see the world probably, again divided into two factions, being the, Western allies versus, Russia, China, and, that entire group. What we are seeing is that in order to put pressure on, one group, the Western allies, to put pressure on the other group, what they are doing is they are slowly pressuring them out of some very settled arrangements, things like card networks, things like, the SWIFT protocol for transfer of money. Once this happens, slowly and slowly, everybody who's not in that block is going to start to realize that they cannot take these systems for granted. And while it may not be immediate, but there will be a realization that we need protocols which are truly independent, which are not subject to sanction. And, that is the promise of DLT. How this comes about, there is one could say that CBDCs would lead the way, because a lot of the governments which are on, which are standing opposite the Western allies tend to be more centralized, governments with more, top-down central functioning. So they may want to emphasize on the control, and therefore they might go to through the CBDC route. But we would see that, all of these kind of places, whether it is places affected by a central government failure, or, if they are locked out of global finance, they have all turned towards distributed ledger technologies, whether it is Venezuela. Now, the most immediate thing we saw in Russia was that since Visa and MasterCard are out, they are now moving to Union Pay. This will probably, soon give way in the longer term to probably using, DLT-based networks. And, I'm not saying that suddenly everybody's start going to be using Bitcoin, but this is definitely going to be on the cards.
All right. With that, I just have my slightly different perspective in terms of the impact of the war. I think from a pure technology standpoint, DLTs and cryptos, I don't think there is going to be any impact at all. Purely from a pure technological innovation and evolution standpoint. Clearly, there is pressure on currencies now. For example, India and Russia is saying that they will do only ruble currency trading. For example, China is focusing on how to get rid of the greenback dollars as a form of international trade. So there is going to be that. But the only immediate impact that I see is in terms of the continuing, refugee problems, that we saw 3-4 years back, and now with this, massive migration of people moving to Poland and other countries. Refugees want to be able to still use, different form of currencies and remittances and such. So there may be some immediate tactical impact from the use of fintech, but in terms of the pure technological innovation, I don't think there is going to be a significant impact at all. So that would be my response. And with that very exciting conversation over the last 60 minutes, I wanted to thank both Rishabh Sinha and Kathy Kao from Seattle for the opportunity to discuss some of these things. I know there is one aspect that I wanted to touch on, which is around cybersecurity based on the question, but that is a different topic for a different forum. So we'll do that. And I wanted to close it out and thanks the organizers of this conference as well, and all the support that has been provided by the administration to conduct this session. So thank you very much. I think the next session starts in about 10 minutes time. So hang on and we'll continue this conference. Thank you. Bye-bye.
Tarini, it's live. You can start.
Okay. Good morning, everyone. Welcome to this session where we're going to be looking at ESG standards, and we're going to be discussing about businesses and how they need to transition towards sustainability and the importance of that. And this is a very important issue that we're going to be discussing, particularly also in the context of the very fast changing and fast developing legal and business responses that are occurring in this area, in the context of ESG, climate-centered business and finance and so on. And the hallmark of sustainable business and green finance is the integration of environmental, social, and governance factors in the very working of a company, in the very structure of the way a company works. From strategy to investment, from decisions regarding products, credit, risk management, external reporting, all these aspects become a key element of ESG. So ideally, it's not just about reporting standards and just doing the bare minimum that is required by the law. And it covers a range of issues and so on, and which companies then need to look into and so on. I'm Professor Tarini Mehta. I'm from the Jindal School of Environment and Sustainability. I'm an environmental lawyer, and I've been working in the area of environmental law and looking at these, the issue also of corporate governance in the context of environment and climate change. And we're very lucky to have with us some very esteemed and renowned panelists who've been working in this area from the side of economics, law, practicing in this area. So I'm happy to welcome the panelists. Let me introduce our panelists briefly. We have with us Professor Naresh Singh. Dr. Singh is Professor and Vice Dean of Jindal School of Governance and Policy and Director of the Center for Complexity Economics, Applied Spirituality and Public Policy. And he also has a transdisciplinary PhD in environmental sciences with over 3 decades of experience and work in public policy. Dr. Joseph Chun is with us from Singapore. He is a partner in the ESG practice and also an adjunct associate professor and member of the Asia Pacific Center for Environmental Law at the Faculty of Law in the National University of Singapore, where he teaches environmental law. And he has been advising on ESG risk mitigation, liability management, and so on. And we have with us Professor Chitrakalpa Sen, who is an associate professor at Jindal Global Business School, an economist by training. And his research includes, again, looking at green stocks and growth economics and so on. So we have a very esteemed set of panelists with us who are going to be leading us in this discussion regarding ESG standards and so on. So I'm going to start our discussion by asking each of the panelists to share their views on what happens if companies don't transition to sustainable business and finance models. If businesses choose to sort of wait it out and see what happens and have that kind of an attitude. So I'm going to start with Professor Singh and Dr. Chun and Professor Sen.
Well, thanks, Tarini. The first thing I would say in response to that question is the challenge of first mover advantage or first mover disadvantage. So some players, some business actors would think of if you're moving on a playing field that is not level and you're moving first on that, some of them might perceive that they will be at a disadvantage and might want to look over their shoulders and wait till others move. Several others, more entrepreneurial, bold, innovative business leaders see the advantage in moving first, even in a playing field that is not level, and so they go ahead. And so you would have a mixture of those who want to wait it out and those who don't. Now, the waiting out issue is, of course, being forced by regulations. So if public policy regulations demand certain levels of ESG standards in a given jurisdiction, then the option of waiting it out is no longer there. Mostly in most jurisdictions, now we have transitioned quite a bit, from the days of corporate social responsibility, where business sort of did a little bit of philanthropic good to what I would call sort of conscience money, where they were doing a lot of harm, but would put a little bit of corporate investment into some community for a good. Those days are long past us. CSR is still there and still useful, but now being done within a broader context of ESG. Even the triple bottom line, which is still a useful thing, going beyond just financial reporting, is also sort of incorporated in the broader ESG. And so professional bodies, international networks, not only government public policy, are looking more and more towards ESG standards. Final point I'd make on this is consumers are becoming more aware, so that more and more first mover advantage is more often the case than first mover disadvantage. And people sitting there and wanting to wait it out are likely to suffer a disadvantage, a competitive disadvantage, rather than a competitive advantage. That's how I see it for the moment.
Yes, you're right. So in that sense, it gives an advantage to those who realize, and that's the next aspect we're going to look at, that it actually also brings opportunities for companies. It's not just a question of managing risks and complying with laws. Dr. Chun.
So I agree with Naresh that the risks of what do you call it, first mover disadvantage, I think it's small compared to the first mover advantage, but it's also very important for companies to now be very aware that there are many aspects of the risks that are facing businesses. If you talk about environmental risk, then there are many of these risks: physical risk, extreme weather, transition risk due to regulations, due to change of consumer preferences, and legal risks due to being sued. Cost of funds changing when banks, insurers, asset managers start turning away from your business because they think your business is less safe because you're not managing the risks that you are facing as well. So when you are faced with all these risks, they translate into financial risks. And I think any director who is doing his fiduciary duty to his company would not be doing this duty if you were to just sort of sit still and do nothing and wait for the risk to actually hit the business instead of taking preemptive measures.
Exactly. So doing too little, waiting too long, and it means you're going to have to play catch up basically with your peers. You're going to see the value of various assets being challenged over time. So there's a number of these risks that companies then are putting themselves in the face of. Professor Sen.
Yeah, so I hope I'm audible.
Yeah.
So, I'll just take it from where Dr. Singh and Dr. Chun have stopped. Apart from the physical risk and the transitional risk, I would also like to add two more risks. One is reputational risk, another one is financial risk, right? So in this age of ethical investment, so everybody's worried and concerned about ethical investment. What am I putting my money, right? So am I putting my money in the companies who speak my language? So are they as environmentally aware as I am? So we have seen several cases where where it has seen that where investors have put the money in, so that those companies they have not really invested their money where their mouth is. I work in the area of financial economics, right? So the existing literature in finance, so it says that there is also a significant amount of financial risks involved if the companies they do not go green. So in short, it merely pays the companies to go green. The literature says that the green companies, they tend to have better financial health. The green assets, they are less volatile and they perform better during the periods of crisis, and making these assets necessarily more resilient and making them good hedging instruments. The green performance of companies, they have a positive impact on the company's profit margin and the stock prices. And of course, the external investors' interest in investing in socially responsible companies would prompt even the the profit-minded managers to go green if they believe that by going green that will simply increase the market value, right? So in short, it pays to be green, and if the companies that do not go green, so there is a big chance that they will soon be obsolete.
True. And also, as we move forward, we should also keep in mind that while the ESG standards have come more to the fore because of climate change concerns, but apart from climate change impacts, companies also need to keep environmental impacts, other environmental impacts in mind, water pollution, air pollution, water stress, toxic emissions, and so on. So when we're talking about ESG, we're talking about a whole gamut of environmental problems, social impacts, and governance-related issues that companies need to keep in mind. So now, what does all this actually mean for companies? Dr. Chun, I'm going to ask you to step in here since you've been working in ESG risk management and ESG consulting. What does this mean for companies?
Sorry, what does this mean for companies who are facing all this risk? I think they will need to start to identify, put in place a governance system. Directors, leadership will have to identify what kind of processes they need to have in place, work with senior management, put these processes in place. How do you identify your risks? How do you assess them? And then how do you manage them? And then you may need to find out what are the data that you are lacking to make decisions. How do you get the data? With the data you have, then how do you proceed? How do you measure your performance, and then how you sort of review your performance? Do you need to change your performance, and so on? So basically, having a management process in place, that's very important now. So you got to start thinking about that sort of from day one. Sorry, it's a bit late already, but better late than never.
And all this this requires a great deal of structural change, and also it means that there has to be a change in the attitude of the executives of a company, in the way they plan the company business model, businesses going forward, etc., which leads us to something which is right at the heart of business, a reevaluation of, in a way, the very purpose of a company. And ESG standards are changing that. So a company can no longer just focus on profit generation and shareholder interest in the context of profit generation. So I would ask you, Dr. Chun, and then Professor Singh to share some thoughts on this transition which is taking place.
So in fact, I agree with what Professor Sen said earlier, which is that even the profit-minded business and managers would realize, should realize that even from that perspective, it makes sense to go green. So it's not just a matter of being altruistic, because that would help, but you don't have to be altruistic to realize that it's in your own interest to be green. And the thinking hasn't changed that much, as in no one expects or requires a company to be ethically minded, but applying even the self-interest sort of approach, you would be doing many of things that are expected of you in terms of getting the risk management processes in place, in terms of planning your strategies to tap on the opportunities that are before you.
Professor Singh, you've been doing some research on this aspect in the context of the philosophy around businesses and please share your views on this.
Right. Let me say two things, Tarini, on this. We have talked a lot about ESG in terms of the environmental component, and the risks from the environment are quite clear. Our colleagues have all mentioned the climate risk dimension and physical and transition risks bubbling through the economy and then impacting on the financial system and feedback loops and so on. So that's pretty clear. The social risks, we need to identify what those are as well. And the way business operate can exacerbate inequalities in the society. It can have really negative impacts on large numbers of people living in poverty. It can also have impacts on employees and their various communities. And so the risk sources from the social dimension need to be covered. Of course, the governance arrangements continue to be there: corruption, fraud, the inequitable pay brackets between genders or between leaders of business and so on. The data shows, that of categories of people that are least trusted in society, business, bankers, and so on, are in the same category as politicians. Very low trust. Now that should worry. That should really worry senior business leaders. And if they're going to have a sustainable business and people are increasingly distrusting of business, means something is missing. And that should be pushing them to consider the broader dimensions, governance, social, as well as the environmental. But ESG is seen as a kind of a plaster on a cancerous social operation. I think one might safely say that it really started with our grand old economist, Friedman, out of the Chicago School. And when he clearly said that business has no purpose helping to have any societal regard or any other regard for that matter. There was one purpose for business, and that was profit maximization. Laws in so many countries, the law demands that business focus almost entirely on profit maximization. Now there has been rethinking on this matter. The purpose of business, it put very well by this book just that came out of Oxford University Press last year on putting purpose into practice, in which it argues that the purpose of business has to be to make the world a better place, and in so doing, make a profit. In other words, the purpose of business has now to be defined as profitable solutions to the world problems. So it's not a problem of not making profit, that remains valid. But we have to reorient our thinking. We are facing civilizational challenges. We cannot afford to have such a major actor, the business sector, with impacts on people, profits, and the planet, to continue to be behaving as though they are an outside force, because our policymakers, look to them to generate what is the so-called GDP per capita growth and job creation. Yes, critically important, but you can do that and do it differently by making profitable solutions to the world's problems. You are supposed to be a public actor. So Friedman is dead, I will argue, or should be dead. Should be dead. It's not dead.
Yeah, and
actually, talk to my colleagues to see how they will react.
Yes.
I mean, can I jump in here?
Yeah, please.
Yeah, thanks. I mean, thanks, Dr. Singh. That you have mentioned about the Friedman doctrine. From 1970s, we have come a long way, and in so the Friedman's, the stockholder profit maximization. From there, we have come to 1984, Ed Freeman's stakeholders benefit maximization, where Freeman said that it's not only about the stockholders, it's about the stakeholders, which is the community, the environment, etc. Now, it's very interesting. I wanted to mention this, and I would like to hear what you think about it. I had a chance to talk to Ed Freeman last year, and we asked him about this debate, the Friedman-Freeman debate, and he said that, like you said, that the Friedman doctrine is dead, right? So it was very much alive in 1970s and 80s, during the Cold War time, right? So where the companies, the US was in a collision course with Russia, the competing with Russia and everything. Now this, given this conflict is happening in Europe, it might be very interesting to see, if there is a resurrection of the Friedman doctrine, at least partially.
Professor Singh, what's your take on Professor Sen's?
Yeah, I don't know that the conflict between Russia and Ukraine would have a significant influence on one way or another on this, but I do believe that the way we have to operate at several levels. The Friedman doctrine, while not not the dominant guiding principle of moral behavior, if we put it that, at the moment, it still has so much influence in so many quarters of the business world. But my hope lies more with the increasing awareness of people, the increasing awareness of academics of the gross inequalities in our world. I recall Manmohan Singh in India, former Prime Minister and Finance Minister, once say, "I know you guys are wealthy, but please don't flaunt it, because I could have a social revolution on my hands. When the poor people see how the rich people, how much they have compared to what they have." So these gross inequalities, I look at the environmental situation. Climate change is a civilizational challenge, the way it's going to change the way we live and operate. Look at the mass species extinctions that are occurring. Many have not yet come to understand that the way the earthworms survive or not is directly linked to the way they survive or not. Putting it like that, the way we teach our children and grow their awareness in the web of life, in the social interconnections, in what we call, the whole complex adaptive system in which we all live and operate. Our educational system has to shift the way we think about our society and the way we address problems. And then I suspect we will have a real shift over to the purpose of business as completely moving over from the old Friedman doctrine to one in which business is really engaged in making a profit, but solving real problems in doing so, societal, environmental, and social governance issues. And I hope that day is close at hand.
Yeah, and I mean, I personally believe it is close at hand. Also, it's close at hand because there's no other way for business to be done. As we move forward, climate change is going to accelerate. Environmental issues are very serious. Biodiversity loss is one of the most serious problems we're going to face. So companies are going to have to change. So even in order to do good business, even in order to make those profits, they're going to have to change. The problem is that in this transition, they may, for a time, have to face certain reductions in profit, perhaps in certain sectors and so on. But that's something which, in the long term, is going to be in the benefit. So there has to be a change in mindsets. Plus, of course, shareholders are demanding it now. So the landscape is changing. Companies have to keep stakeholders in mind by law, and also, when the landscape is changing in terms of what consumers want, shareholders want, then that has to. So in a sense, it has to move forward. That companies have to change.
But and also, Tarini, if you look at the work done by the Commission on the Economy and the Climate, they have identified $26 trillion in opportunity between now and 2030. On the other hand, the Citibank has estimated that we will have a $33 trillion write-down on stranded assets as a result of climate change. And by the year 2100, it goes to 100 trillion. So the loss of assets from environmental impact and the opportunities that many companies are not focusing on are there. The economics we have now, I would argue, is increasingly what is being called economics of mutuality. The new economic opportunities, and the big business companies like Uber, or all these food platforms and whatnot, are business of increasing returns. The traditional diminishing returns of economics that we learned that Economics 101 is shifting. And it's the business leaders who see this opportunity and have the kind of inspiring leadership that are going to be the winners.
Yeah, exactly. And that's a point which more and more, directors of company CEOs are recognizing. Doug Peterson is one who recently stated that, ESG should not just mean risk alone. That's an incomplete way of looking at ESG. And you have to consider the holistic approach. You have to consider opportunities and so on, as you've mentioned. So that is something which is catching on. And it has to. Anybody who is has a good business mind, according to me, also will take this on. And of course, then there's risk, there's litigation risk. So Dr. Chun, I'll ask you to shed some more light on that. Climate litigation, of course, is a growing risk to companies. There's claims that they can face through various different types of claimants, and What has been your experience in this, working in a law firm, advising clients on the litigation risk aspect?
So in Singapore, the litigation risk is actually small. I think our legal system is relatively conservative. So I think the way we address litigation risk is to advise companies that, look, you have, as directors, you have fiduciary duties. Your fiduciary duties are carry civil liability, but also criminal liability. So while the risk of being sued by a shareholder, by an investor in Singapore, by civil society in Singapore is very small, the risk of criminal liability or being prosecuted cannot be ignored. So we think there's a greater likelihood of getting prosecuted than being sued for damages. But that's the Singapore situation.
And then there have been successful criminal prosecutions of companies in this regard?
No, not yet. I would say this is a relatively new, I think, sort of development. Last year, a group of lawyers, including me, we wrote a legal opinion on the director's fiduciary duty to consider climate risk as well as to disclose climate risk. And so we collectively reached the conclusion that this is a real risk, notwithstanding the fact that no one has been prosecuted for it yet. We think that will come in time, the criminal liability as opposed to the civil liability.
Yes, of course. And if we look at it from the point of view ecocide, and as you know, there's internationally there's a lot of pressure to bring it into the Rome Statute and introduce it back in there. It was supposed to be there, the crime of ecocide. So if ICC gets jurisdiction over that, or you have more and more courts around the world accepting cases on ecocide and passing judgment on ecocide by companies, and that's also going to be another area of serious legal risk for companies. And as we go forward over the next decade, I definitely think that that's going to become a major issue.
Yeah, sure. Can I also just add that indirectly, litigation risks in other jurisdictions, such as Australia, the Netherlands, in the US, will also affect Singapore companies, because if Shell in Netherlands is told that he has to cut its Scope 1, Scope 2, and Scope 3 emissions, it will look to its suppliers, it will look to its supply chain, value chain, and right into the contracts requirements to improve or to decarbonize, to improve on their environmental performance. All these will affect the businesses in Singapore which are doing business with companies that are in the jurisdictions that have high litigation risks. So indirectly, yes.
Yeah, exactly. And most of these companies are multinational, they're large companies, so they have to keep in mind these different jurisdictions. Of course, you have the other side of it where there'll be differing standards for the developing countries and differing standards if they're operating in Europe, and that's another problem to deal with. But I think with law, the way it's developing, for instance, even in the Indian context, the ESG standards and the laws are developing. So multinational companies are going to have to deal with higher standards across countries. And what does all this mean for directors and boards? The litigation risks, as well as the changes that are transition taking place in the context of a company, how it operates, how it should operate, the business model of a company. What will this mean for the boards and directors and their duties now?
So, if I may, I think just looking back at the fiduciary duty again, the duty to act with diligence as well as with loyalty to the company, it simply means that you have to consider these risks because they are adverse to the best interest of your company. So you can no longer sort of dismiss this as some do-gooder, do good kind of thing. Oh, we're not in the business of doing good. You don't have to be in the business of doing good to care about environmental risk. Doing well includes doing good now, because if you don't do good, then the risk of not doing good will affect your ability to do well.
Right. So in that sense, directors and boards have to re-evaluate their own duties in that sense to the company, to shareholders, to stakeholders, and of course, they can also be held to account for that legally. Another aspect of this transition, a key part of this transition also is green investing. And international investors, as we know, are mainstreaming green investments more and more. So Professor Sen, this is an area you've been working on, and we'd like to hear from you on what green investment practices are we seeing? What is the thinking about this? How is this sector moving forward?
Thanks. So green investments are basically investments in companies, that are environment friendly. Right? So they're investment in energy stocks, wind, solar, water. In the last decade, we have seen a surge in green investment, which you can also call a green boom. So pretty much everybody is spending on carbon friendly projects and securities. Green stocks all over the world, they continue to beat the market benchmark indices consistently. India is no exception as well. There are several studies done in India. So I have been a part of a couple of studies. There are some other studies done in some other institutes where we have shown that India has some sustainable indices like Bombay Stock Exchange, BSE Carbon X, BSE Green X, and the BSE 100 ESG. So all of these indices, all three indices, they exhibited a positive average daily return pretty much throughout 2020, from January to September 2020, throughout the pandemic period. During the same period, the BSE 100 ESG index, it outperformed the BSE Sensex in annual return. So between, I think, April 2020 and November 2021, the top 50 Indian ESG companies, they consistently offer more returns than a Nifty 50. So I mean, it's not surprising that the investment in ESG funds are literally ballooning all over the world. I've seen a recent Bloomberg study which says that the ESG investment by the end of 2022 it would be over $40 trillion, and by end of 2025 it would be over $50 trillion, 53, to be more precise, which is more than 1/3 of the total globally managed asset. Now, that is massive. And India is, I work, in Indian context mostly. So, India is a significant market for green investment, right? So in India, the ESG assets has increased, I think, from somewhere around 26 billion rupees in November 2019 to around 120 billion in December 2021. So that's, more than five times increase. So, and that, in recent past, Indian government has, come up with, policies which puts India actually on the path to become one of the largest green energy producing companies. So we have, witnessed, fastest growth in renewable energy capacity among all large economies between, 2015 and 2020. And we aim to double the new installations, between 2021 to 2026. So, it's exciting time ahead. So that the plans are in place. Now the only thing that needs to be seen is that, how well, these are implemented.
And of course, and the question which also comes up is that are all these investments truly green? That's a criticism which comes up. There are corporations that often engage in marketing, or they'll obfuscate what they're actually doing. Greenwashing, ESG washing, what is called, and you'll have managers of certain funds that state that their focus is environment and social issues, but you find that they're also holding shares in fossil fuel companies, that they're holding shares in mining companies, weapons manufacturers. So you have this side of the story as well. So how much of this is actually green investing, like truly green investing?
Well, I do not have access to the Indian data, but it's an universal phenomenon, like what you have mentioned. So I remember reading this report by a think tank called Influence Map that came up, I think, sometime last year, I think in August, which said that more than 420 out of around 600 ESG funds, equity funds, they have their portfolios are not aligned with the Paris Accord standard. So the ESG funds, they are holding, like you just mentioned, that they have investment in oil companies, mining companies, the banks, and and in tech stocks, right? So this brings me to the discussion and to the question that I asked Professor Singh, is that Friedman doctrine to me is never really dead, right? So the companies will do anything, that is needed to maximize their profit. They would go green, if profit maximization requires that. And the greenwashing is a part of it, so, right? So I mean, there was this case I read about this airlines company Ryanair, right? So which claimed to be the Europe's most sustainable airlines without any solid ground to that claim, right? So if just claiming myself to be a green company makes my profits too, so then I'll do that, right? So and that's where the greenwashing comes from. But then again, if there is this reputational concern, we have seen this happening with companies like IKEA. IKEA sources its woods. Some of its chairs are made of woods, that came from, I think, Ukrainian forests, which are home to some endangered species. We have, seen claims by Starbucks where they say that, we have, our paper straws are now better, right? So their paper straws turned out to be non-recyclable, while the plastic straws, they were actually recyclable. So, these are even the companies which claim to be green, which are, reputed company, they probably have, some practices ingrained, so which are not so green. So greenwashing is, yes, it's a very common practice. It's what I it's more of a PR exercise than actually serving the purpose, serving the ESG goal.
Yeah. So how does one move companies towards truly green investing, and what's making companies still hold on to this? Because basically this brings us back to the fact that despite all the knowledge out there on risks and opportunities, companies haven't taken it on board clearly enough.
So I personally think that the onus is both on the regulatory authority as well as the investors, the individual retail investors. For example, I know that in European Union, so they came up with a disclosure regulation called SFDR, the Sustainable Finance Disclosure Regulation, in 2021, which introduced a set of new disclosure requirement for funds. In UK, there's this Competition and Markets Authority that has come up with a green claims code, right? So to curtail the the fake green claims made by the firms. So the regulation needs to be there. There needs to be a closer scrutiny by the regulatory authorities that what the companies are claiming and what they are actually doing. So whether there is a parity, and of course the retail investors they have to come in as well. So there needs to be a more cautious scrutiny by the investors themselves. So I personally believe that the only gold standard here is that to match the ESG firm's performance against the Paris Accord standards. So that's, I think, the only way we can verify what the firms are, claiming whether they are doing exactly that.
If I might add,
yeah,
Tarini, to what Chitrakalpa is saying, just add on, support all that he has just said. If you take the other dimension of green finance, which is, for example, green bonds being used to raise money, and now they have green bonds, they have social bonds, they have sustainable development bonds, the whole gamut. And the way they are doing it is quite interesting. I've just done some work in sub-Saharan Africa, in which we looked at what might stimulate green capital markets in sub-Saharan Africa, and look at the best leading practices that they are using. So greenwashing is clearly of great concern. So the important thing there is taxonomy. So the European Union has a taxonomy, and so it has to be pretty clear. There is a debate of whether we should have shades of green or a very strict definition of green. You're either green or you're not green. I come down on the side of, while shades of green might encourage more inflow of what might be termed some kind of green finance, I argue for strictly a green definition. You're either green or not green, because the room for greenwashing is too great. Now, once you have that taxonomy well set up, which several countries are doing, and they're drawing from the regulations of the European Union taxonomy or the climate bond principles, for example, then you have to have a clear definition of the use of proceeds in the case of bonds and so on. and then an external independent verification system that looks at those proceeds and how they were used. So I would imagine that similar kinds of approaches would help in the greenwashing, which is, as Chief Kalpa mentioned, is a significant problem and needs to be addressed more and more. Also, as you know, as companies get exposed when they are misusing their opportunity and getting tax incentives and all kinds of things for green investments and green funds, and they are in fact not following strict guidelines, when they get exposed in the media, I believe that will also send a warning signal to others not to behave like that.
Yeah, definitely. I agree with you. There needs to be a strict green standard. I mean, when you consider just the fact that 1 million species are facing extinction, and what this will mean for companies and products and their resources, their entire functioning, just from that angle. And of course, then there's the environmental angle, and then of course, as you mentioned right at the beginning, there's a civilizational angle. If there's no life on Earth, there's no company. So if you consider it from all these angles, there needs to be very strict standards. Of course, coming out in the media against companies that are operating in a substandard way. All that could also add to this. Add the pressure on companies. Dr. Chun, what is your view on this? How can one move companies towards truly green investing, truly green practices?
So I agree with both professors. There are currently the legal measures in place through the use of securities law on misleading statements, through the use of consumer protection laws on, again, misleading advertisements or descriptions of your products and services, including financial products. And in Singapore, apart from these, we are introducing enhanced disclosure requirements for ESG retail funds, basically requiring fund managers to explain what the ESG objective is, how it's to be achieved, how it's to be measured, how the portfolio is selected, how a performance be measured, and then also require regular reporting. So all this to avoid, to minimize misleading the investors. Also agree with Professor Singh that taxonomy is very important. In Singapore, we have started the process. We started looking at it last year. The dilemma is what is green in Europe may be too high a standard for developing countries. And so we are trying to find a way where we can have a system, a taxonomy development model, which is enables comparison with taxonomies elsewhere, but at the same time takes into account local circumstances. Because a lot of the EU taxonomy definitions are based on EU standards, EU laws, what's permitted to be emitted, for example. In South Asia, the standards are different, but we are trying to keep to the same metrics while tweaking the thresholds for what counts as green and what doesn't, but we use the same metrics so that there's comparability. The other thing we are doing, which Professor Singh may not find acceptable, is we have the green bucket, the red bucket, and we have a yellow bucket. The yellow bucket being for activities which are, while not green as in not aligned with Paris Agreement, but are still necessary in today's society and for which there's no alternative. Examples are aviation, steel, concrete. There is already some green cement and all that going on, but not enough in terms of scale to keep society going. So for those, it's not strictly green, but it's considered to be transitional. If it meets a certain time-bound sort of pathway, we are heavily decarbonizing the activity, but we know it's not going to get to net zero by 2050 because aviation isn't on its way there based on current technology. So we have the taxonomy, we have all those things in place. Hopefully this will minimize sort of greenwashing, but I don't think it will totally eliminate it. So investors have to do their own due diligence.
But do you think the Asian standards, as you said, that there's, there is different standards and perhaps have to be, but do you think the standards in Asia are green enough? Is it enough, or are we sort of moving too slow towards decarbonization, towards moving towards sustainability?
So if you go back to the Paris Agreement, while there is a provision that says collectively we all have to be net zero by 2050, of course, as modified by the IPCC report, but it also says that due consideration must be given to the needs of developing countries. So developing countries will, it's acknowledged, will take longer to get to net zero. So there has to be an allowance for that. Developing countries have been saying to developed countries, give us the financing. If you don't give us the financing, how do you expect us to get to net zero as fast as you, or even faster, when we have so many social issues to address, poverty, and so on? So question of whether we're doing fast enough, I think it varies from country to country, but I think due consideration has to be given that developing countries are starting from a very different starting point. Eventually, we will all get there, but our pace has to take into consideration our situation. I don't think we can get away from, unless developed countries come up with the money for the financing.
This is now we've kind of reached a very crucial issue in the last 10 minutes of the panel. But Professor Singh, would you like to add anything to this?
Yeah, I just say, to the points that if there are clear definitions of the red, yellow, and green buckets, and there is enough built-in, guidelines and safeguards, so that if incentives are provided for green, that those same incentives don't go to yellow or red, and it's really clearly done, and we build in incentives to encourage the transition from red to yellow to green, then I would not have an objection. But if it is such that people are able to get the same incentives when they are yellow by claiming to be green, I would have a major problem, and I'm sure Joseph would also have a problem with that. So on the issues of moving towards net zero and so on, huge problem. I mean, I started my work on climate change in 1990. At the World Second Climate Conference, and was involved in negotiation, the Framework Convention that was signed in 1992. And then when I saw how difficult these negotiations were and how intransigent the problem is of climate change in getting the world to move together, and it has to move together because this is the global commons, it's not, it's the atmosphere. And so it's really complicated and difficult. And what is really troublesome though is that after Paris and the agreement and everything that we got out of Paris and previous work, 2018 and 2019 were the years of the highest carbon dioxide greenhouse gas emissions ever. So what all countries are arguing is that we have to go up before we go down. We have to get our economies to some point, and so we have these distant targets like 2030, 2035, 2050, and so on. And in the meantime, we are moving towards disaster. We are sleepwalking towards the cliff. And I don't know that how we will get there. I believe that people will have to begin to sue their governments, and the courts will have to get involved and force governments to take more action, because politically the will is not there. It's not coming up. And I agree with Joseph, for example, that developing countries need finance and support, to get their technologies changed, to get investments in the right place. But they are also using that as an excuse for not taking the kinds of actions that they need to take. So a combination of these factors will have to be put in place. In several countries, as Joseph, I'm sure, is aware, younger people have been suing the government because of violating their constitutional rights. In Canada, for example, of not the guarantee to life is being violated. So we'll have to have a combination of these actions, I would imagine. imagine. But we're not getting there. We are on track to 3.5 to 4 degrees right now, while we, negotiated and hoped for 1.5 degrees increase in surface temperature compared to pre-industrial levels. We're not on track to where we want to be. So some drastic things need to be done.
Yeah. And we have, as you rightly said, we need to more and more lawsuits, and of course that's happening. Young people are, I believe, going to play a key role in this. And as you said, the right to life, of course, is climate change litigation. There's very interesting litigation trying to hold fossil fuel companies responsible for their role in climate change. And then there's also litigation which is talking about the rights of future generations, that we have a duty to the future generation, and that's clearly connected with climate change and the kind of impacts it's going to give rise to in the next 50, 100 years. And how is that right going to impact companies, and the way they work is also something then to consider. But also, I think there needs to be, in a way, a rethinking, particularly from the point of view of developing countries, of development and development models, and what is this level of development that they're trying to reach. And as you said, that we need this sort of a pause because we need to develop to this level, and then we'll catch up. But you're not going to be able to catch up because the atmosphere is the atmosphere. The GHG emissions will go there. They're going to impact everyone equally. Europe and India both are going to be impacted. The atmosphere is not going to say that, all right, India needed time to develop, so fine, I'll give it a pause there. And in fact, our part of the world is going to be worse impacted sooner. And then how are we going to deal with that? How are we going to deal with sea level rise? How are we going to deal with the kind of disasters that this is going to lead to? We're not prepared for that. So somewhere I think there needs to be a complete rethinking of development models, the ideal of development that we're trying to reach. Are we trying to reach a European model? Is that the vision we have in our mind? Well, that's not the most ideal vision of development, according to me, for Asia and for India.
Indeed. I think the fundamental shift you're hinting at is how we measure progress. And what is the good life? And if we continue to think that progress is measured by consumption and GDP per capita increases, we have lost it. If we look more on human development, prosperity, thrivability, and even happiness as measures of progress, we have a chance. And I think the more we do work on those public policy goals, the more we have a better chance. Otherwise, the debate continues. For example, the debate among economists is, has India deindustrialized too fast or never industrialized enough to be able to produce the kinds of jobs that it should? It is in service too much. Percentage of service of the economy, the service component, the argument is, but that's missing the point. They continue to measure progress by material consumption and GDP per capita. And India has a great opportunity to teach the world an alternative way, but unfortunately, it is busy mimicking the West at the moment.
Yeah.
And doing a bad job at it, I would argue.
That's true, but also I think it would do a bad job because that's not the model that will apply. For instance, if we talk about jobs, but in the Indian context, and Dr. Chun, you can also share with us. So in the Indian context, there is an entire job sector that can be developed through developing the rural sector, through developing those livelihoods, which are often also traditional livelihoods. So one doesn't need to transition people from there to an industry for it to. And of course, as we know, the kind of work conditions they have is poorer. The kind of quality of life tends to, of course, be poorer. And then, there's the environmental impacts of that. So in fact, there needs to be how we see development and progress needs to be based on that country's social, economic issues, plus the culture, plus the history, all those aspects need to come in. And in that sense, Dr. Chun, what is your view on that from the Singapore perspective, Singapore point of view?
So yeah, in Singapore, our leaders have been saying the same thing. There are a lot of job opportunities for the green economy. We're trying to promote this idea. At the same time, we are also working on how do you transition the workers from the old economy to the new economy, whether it's retraining or some other sort of way to so to keep their jobs. We have a lot of workers or people who are employed in the oil and gas, oil refinery sector. What do you do for these people if you phase out your oil? Can every one of them retrain in solar industry? And if not, then what do you do with all these people? So I also think sometimes we people who think or care about the environment forget that there are many people who actually don't, for many reasons. Either they are not aware, they've not been reading the news or watching the news, or because they are too preoccupied with their day-to-day sort of pressures. I am reminded of this very often. In Singapore, occasionally you will, not occasionally, but often you will see people saying, oh, carbon tax, that's just going to raise our cost of living and we are against it. Or they will say, why do we care with so much biodiversity? We can't eat biodiversity. We'd rather have more roads to make car ownership more affordable, because our aspiration is to have cars. It's very hard to tell these people, no, that's not the kind of life we should aspire to. Number one. And number two, it's very tricky for a politician to say these things to the electorate and hope to get re-elected. They say, oh no, you should be aiming for less materialistic consumption. It's very hard to, I can understand that. It's very difficult for politicians to get that message out to the public.
Yeah. So we have, I think, run out of time, I believe. I think we have just a couple of minutes. So this was a very interesting discussion that we had on issues which will require a much longer session and several more sessions to first work around and then to perhaps find some solutions. As you rightly said, Dr. Chun, people don't even understand the gravity of the problem. They don't relate it to themselves. That's one issue. Of course, we also have the fact that companies are clearly not taking on the risk and understanding and acknowledging the risks as much as they should, or the opportunities. And so therefore you have greenwashing, you have ESG washing, and other issue that we need to work on. So all this means that there needs to be several levels of solutions. There needs to be solutions from the point of view of law and policy, but also investors, shareholders, stakeholders, people suing their governments, as Professor Singh said, people holding companies to account for their investment decisions and so on, as Professor Sen said. So all this needs to come together for us to move forward. But also, this is not just about the environment. I mean, it is about the environment, but it's also about good business, because going forward, if businesses do not transition, they are going to be at a loss. There is no other way going forward, because we have brought ourselves to a position now where we are facing this level of biodiversity loss, this level of climate change impacts, where this is the only way if humanity is to survive, in fact. So now it's not even a question of this make the company look better, or it's about an image, or it's about diversifying product. This is the only way forward. So considering that, this is something that companies, lawyers, all interested people need to take on board very actively and urgently. So I want to thank the panelists who took their time out to be here. Thank you, Professor Singh, Professor Sen, and Dr. Chun. This has been a very enlightening and lively discussion, and I look forward to discussing further on these issues.
Thank you, Professor Mehta, for a wonderful chairing of the session.
Thanks, Tari. Thanks, everyone.
Thank you very much. Thanks, everyone.
Thanks all. Thank you.
Shona, I think you can go now.
Okay. Hi, everyone. Welcome to the fourth session of the conference that we are hosting with Seattle University on societal impact of commerce, sustainability, technology, and social good. This session, session 4, is going to focus on the impact of e-commerce businesses on MSMEs in India. I am joined by two stellar professionals, both of whom are specializing in various aspects that we will touch upon in today's conference. So I'm joined firstly by Benny Chugh, who manages the research at the Future of Finance Initiative. Her work focuses on identifying systemic stability and consumer protection concerns in digital finance. She also contributes to the social protection open digital ecosystem workstream at Dwara Research, where her work focuses on designing and implementing citizen-centric digital social protection delivery platforms. I'm sure there is a lot more to what Benny does, and she has been, we are very grateful that she has been a consistent partner in all our academic endeavors. We also have, Professor Lakshmi Srinivasan, who is a lecturer at the Jindal Global Law School. She specializes in intellectual property and information law, and she's also currently pursuing her PhD at the law school. She conducts various courses on wide-ranging subjects from environmental law and international aviation law, technology law, apart from teaching on intellectual property. Her research interests include intermediary liability for copyright infringement and laws concerning international civil aviation. And she writes in many journals of repute as well. We are joined by this stellar panel, and this is important because the conference today, or the session today, focuses on many different aspects of e-commerce and businesses in India. Now we'll get into more details about this, but I just wanted to quickly clarify certain session, ground rules. Since there are just the three of us, we'll be having a free-flowing organic conversation. So Benny and Lakshmi, feel free to jump in at any point of time. I'm a beginner in the subject, so I'm looking forward to learning so much from you guys. For the audience in general, please feel free to, jump in with any questions. We'll be checking the chats. We'll be also checking the YouTube live comments. If you have anything that you would want to contribute or ask our panelists, please feel free to do so. We are roughly going to target, 45 minutes of active conversation, and the last 15 minutes we will reserve once again for audience questions. With that, I would request both our speakers to give us a few opening remarks, perhaps the thoughts that come to, which are of critical importance to the subject. So maybe we can start with Benny. Benny, would you want to make some opening remarks?
Thanks so much, Shoini, and it's really nice to meet you, Lakshmi. I just want to say that as I speak, most of my comments come from the perspective of low-income individuals and low-income households, low-income enterprises, and that's really what my day job gives me an opportunity to think about that stakeholder group and the challenges that they face. And in the MSME space, the micro, small, medium enterprise space, what we do see is in India, and I think also elsewhere in the world, the micro segment. Now, India, of course, has a very bespoke definition of micro segment that you need to have investments, equipments below 1 crore, and your turnover must not exceed 5 crores. That interval seems to be very large, but towards the bottom of that interval is where some of our work kind of emerges from. So in India and elsewhere, what is happening is that the very micro, so India, to just kind of acquaint our audience with the Indian landscape, about 90% of us are kind of in the informal sector. So we don't have regular paying jobs. We don't have social security nets that the employers are supposed to provide. We are in the informal sector. We're highly casual. We're highly contractualized. And many of us are self-employed. And also India has a case of disguised unemployment where wherever employment opportunities go down, there is a tendency for people to move back to agriculture. This has been somewhat of a feature of the pandemic as well. As the cities shut down and employment opportunities dried up, people went back, they moved to agriculture. But again, we have to understand that that's really disguised unemployment, and not so your marginal product that is actually kind of tending to zero. With that kind of employment landscape in mind, in the micro segment, what we see is a lot of low-income individuals therefore are self-employed, and they therefore qualify as micro enterprises. So these could be push cart sellers, these could be fruit sellers, flower sellers, and the likes. And technically, under the definition of micro, small, medium, they qualify as micro enterprises. But what we do see in the country is that call it for a couple of reasons, right? Lack of digitization, high extent of informalization, high extent of contractualization, high extent of cyclicality, as well as extremely low levels of income. We do not get an understanding of the business of the person. So we are not able to assess or make credit decisions of the fruit seller or of the push cart person. So what we end up doing is we end up extending them something closer to a personal loan than something closer to an MSME loan. So at the bottommost segment, I think the idea of the individual and the idea of the enterprise are commingled. They're very closely entangled, and they can't be disentangled because there is not enough margins in the system and technology in the system to understand the business model and kind of innovate for them. So I think that's one bunch of challenges that we have to see, and the role that technology can play. But then there is a host of other, when I come above this low income group, when I talk of the more mainstream micro, small and medium enterprises, there are a host of challenges, and I'm sure Lakshmi is going to touch on them in her part as well. For my part, the big challenges are the lack of digitization across the board in these enterprises. There are a few outliers there. We do see, for instance, food delivery platforms standing out for extreme digitization, but then on the other hand, there is a large swathe of manufacturing industries, large scale of traders, large scale of retailers that are not digitized. So there is this whole, in some sense, barrier for even technology to percolate to them, because digitization, as we know, is the pathway for technology to kind of come, innovate, create efficiencies. So that's the first problem. The second problem is, again, a very granular understanding of business models. And why that is important is because that helps us design, let's say, more suitable financial products. And by suitable financial products, what we really mean is that by administering or by offering that financial service, the person's financial well-being should either remain same or improve, but it should not diminish, right? So the financial product should not have an adverse effect on the person's financial circumstances. And that kind of a granular understanding is very important. I'll give you the case of agriculture, which is still kind of a catch-all employment category for us. And there, what we see is agricultural incomes are cyclical, and that's no news. So depending on the number of crops you're sowing in a year, that's the number of times you will get your income flow. That's the number of time you will generate income. However, you incur expenses throughout the year, because at each stage of the harvest, there is an expense. So there is an expense related to sowing, there is an expense related to irrigation, there is an expense related to keeping the machinery running, so on and so forth. But the incomes are generated twice a year in best case scenarios. Sometimes it's even once in 9 months. But those cases, and then there is an entire value chain that depends on it, right? So in India, I suppose as also elsewhere in the world, cold pressed juices, for instance, are a huge rage right now. And they actually rely on these kinds of, their own supply chains are designed well enough to overcome the cyclicality of the yield. But the in-betweens, the ones who are providing those implements to them, they're still exposed to the cyclicality. And there is no loan out there that can say, hey, here's a loan. You don't have to pay me anything until you get an income. So here's a EMI-free EMI holiday of 9 months. That 9 months corresponds to the time when you will get your income, and then you can repay me in a bullet installment. right? There is a lack of innovation both on the financial services side, but also there are a couple of regulatory barriers that disallow such an arrangement to happen, for instance. So I think that's the second big challenge, that we need to really understand, have a very hyper local understanding of different business models. Agriculture in the north of the country is not the same as agriculture in the south. Garment industries are not the same as agriculture. So each sector has its own really bespoke features, and it's very important for financial service providers to understand those features to be able to serve them better. I'll just pause here. Thank you.
Thank you. Thank you, Benny. I'll come back to this question of low income, because I think that really sort of separates us from the rest of the world, which also sees this kind of platformization of the economy. So I'll come back to that. But Lakshmi, your thoughts on some of the challenges that that we're facing in the sector?
Thank you so much for this opportunity. And let me add something on a personal, or let me start off by adding something on a personal note. MSMEs are extremely personal for me, particularly because I come from a background where my father has a business. He runs an MSME himself, and he actually provides solutions for MSMEs. So my research, I mean, although it is deeply rooted in understanding the legalese of intermediaries and how platforms in general work, and we'll be engaging about e-commerce entities as platforms as well. Adding on a personal note, I do believe that MSMEs have faced the hard end of the stick, especially considering the pandemic. And I think I agree and I resonate a lot with what Benny has mentioned in this particular, in her opening remarks as well, because it wasn't as if MSMEs had a really easy place even before the pandemic. There's a lot of informal nature that is associated with MSMEs, and also when it comes to financials, it's not a very easy task to have or to access such resources. And majorly speaking, there's also this inverted logic that exists. I mean, these are companies which have a largely a one person, a one man or one woman or one whatever gender they identify themselves with, that kind of a person running the entire show. The stakes are much higher, yet the financial resources are not very accessible to them. So although that is not really my expertise, I just wanted to add something of that on a personal note. But coming to what exactly I feel about the e-commerce boom, and particularly coming from the e-commerce policy background, or even the background that where I've been trying to observe this particular space and how it can be really beneficial for MSMEs. E-commerce becomes a very feasible marketplace, and that's where I think MSMEs can assert the independence that has been denied to them for so long. And there is a direct consumer contact. To give you an example, one of our known MSME owners has actually had a product which actually became a number 2 entry in terms of selling on e-commerce, because there is a direct consumer contact, there's a better selling environment, and there are reduced costs of marketing. And these are some things that the e-commerce policy also acknowledges in its effort to reach out to the MSMEs. And frankly speaking, that effort needs to be there currently, not just from the government perspective. I mean, of course, what the government can do is probably from a regulatory perspective can actually just regulate the taxes, or provide better solutions than moratoriums per se. Probably have a better a more sensitive approach towards how MSMEs are supposed to pay back the taxes. That can be the direct government regulatory intervention. But when it comes to other kinds of interventions that probably the government can facilitate, or probably there can be better facilitation or better a better sort of a direction that can be provided for MSMEs, is through the e-commerce sector. And the boom of e-commerce sector is really promising. And it's not just the policy, but I think a lot of others also agree on that particular aspect as well. But there are obviously, being a lawyer, and I can't really resist, but there are certain considerations in terms of regulations that we should be concerned about, considering that MSMEs will have to work with a different kind of an environment where they are more responsible. right? So yes, and that's exactly what I want to shed light on. And recently we've had a lot of shifts with respect to e-commerce entities and how e-commerce entities are supposed to function, and how that would directly impact MSMEs who are coming as sellers on these e-commerce platforms. So one thing would be the intermediary rules that have come recently in 2021, the e-commerce consumer protection rules that came out in 2020, and all of these. The intent is very clear. E-commerce entities are just facilitators of a conversation that happens between consumers and sellers on their platform. So the intent is very clear. The e-commerce platforms, since they are just mere facilitators, they don't really, in case there is any sort of a illegal product or there is some sort of a counterfeit that is going around in that particular platform, the e-commerce entity will not be directly held responsible, or will not be held responsible if they have done a bit of their own duties, which in our legal terms we call as due diligence. So if they have done their duties as per the law, then they are not going to be held responsible by law. So there is a larger responsibility on the MSMEs as sellers to ensure that there are genuine products that are put forth. The second aspect probably I would say from a regulatory perspective, which might be of concern, and this has been a part of our conversation for quite some time, has been dodged in multiple parliamentary sessions, but we are expecting some sort of a positive understanding or a positive sort of a outcome with this particular aspect, and that is data protection. I'm sure a lot of us are shudder to think about what exactly might be data protection. Oh, what is this fancy little term that comes out of nowhere? But to be honest, it's very, very simple. I as a person own my own data, which includes my name, my blood group, whatever it is that's called as personal data. I might make orders on Swiggy. And if they remove my name and whatever have been my order preferences, that also becomes a part of data, and all of those data I have a right over it, and basically MSMEs or e-commerce entities will have to take my permission before they send it out to somewhere else. So that's the basic sort of understanding, a very minimized understanding of how data protection works. And then the law in general just tries to toy around this particular aspect in different ways and in different scenarios, and that's the understanding as we have. So to be very short and sweet, I just want to quickly place it out. So for e-commerce entities, if I were to put out the stakeholders here, there's the e-commerce entities, there is our MSMEs, and then we have our consumers, right? So for e-commerce entities, since they are the facilitators, they are the platforms, which we in legal terms call as intermediaries, basically, they have a shield. But they also have a duty to the MSMEs to ensure that they have complete information. They provide complete information as to how the platform runs, right? And wherever the sellers face an issue, wherever the MSMEs face an issue, those issues have to be addressed in what they term as a grievance redressal mechanism. So of course, if you go to Amazon, there would be one ticker which says, have you gotten any issue? And then they would provide certain links as to where we can address those issues. So those are actually legally or legally ordained duties that e-commerce entities are supposed to have. And as these entities, they also have a duty to the consumers in terms of data, protecting the data, ensuring that the data doesn't go to a person which the consumers never intended to go to, or at least the consumers are informed as to where the data is going. That is there. Genuine nature of goods. So in the duties that the entities are supposed to perform so as to be able to have a shield against them, they are supposed to ensure that there are genuine goods. So of course they will be liaising more with the MSMEs to ensure that whatever goods are or whatever products are being put on their platforms are genuine goods in terms of at least not counterfeited at least. So that's the concern there. And I would assume that this would be more of an adverse measure, and I can take probably the case study of Alibaba here, which used to, in China, counterfeiting was very, very rampant at one point. So Alibaba devised, as an e-commerce entity, devised this kind of a system where they could blacklist sellers on the basis of their repeated counterfeiting conduct, right? So I'm not sure if Amazon currently has that kind of a measure. I'm sure they do, but how often is it applied in India is a big question, really. But yes, blacklisting might also be a measure that e-commerce entities might resort to, which is where I would caution the MSMEs to be very, very careful about the kind of products they put. So which brings me to the MSME perspective. As MSMEs, you are the sellers. And then as an e-commerce entity is merely a marketplace, and where they are facilitating a conversation between the MSMEs and the consumers, and hence the duty becomes double-fold for MSMEs to ensure that they have a proper data protection understanding, or and the goods that are being sold are genuine, proper licenses, and of course, if any consumer raises any issue with it, probably have a better a mechanism of addressing those issues. Now, while I do understand that when it comes to legalese and when it comes to, I don't know, pardon me if I'm generalizing here, but when it comes to MSMEs in general, it's not like they have swanky law firms coming to try and represent them or try and advise them on different issues, right? So of course, there might not I have seen a lot of other MSMEs who really run by this one owner, and they don't have like a separate legal team to try and advise them as to what exactly is correct or what exactly might be wrong. So, but there might have to be more efforts, more awareness, and more more proactive measures from the sides of the MSMEs to try and understand the law, for sure. But while I do understand that the legalese can be a very costly affair, resorting to some sort of a self mechanism, or trying and getting more training, or personnel training in terms of such legal matters would really go a long way to try and simplify what the sort of enigma that the law is for MSMEs. And finally, for consumers, I would just say that consumers will have to, of course, know their rights. They have to build their awareness, and of course keep flagging if there is any sort of a grievance that they have. But I think even though we say that there are three stakeholders in this context, when it comes to e-commerce, when it comes to MSMEs, when it comes to consumers, the major part, or the major chunk of the action is already concentrated between the e-commerce and the MSMEs, and that's where we'll have to focus. But all the cautions aside, and all the inherent morbidity of legalese aside, I believe that e-commerce. I just want to quote what the former CEO of L'Oreal had mentioned once, which is e-commerce isn't the cherry on the cake; it is the new cake. So definitely MSMEs have it up for grabs, and it is something I see, having observed MSMEs in a very limited capacity, can definitely see this conversation and this sort of an emancipation going ahead with e-commerce sector opening up for MSMEs. So that's just those are just my 2 cents of wisdom, and I leave it to Shohini and the floor for any questions.
Sure, Lakshmi. So I just want to ask, I want to steer the conversation to very specific themes I wanted to, for us to address for the wider audience. So I was reading somewhere that the MSME sector contributes to about 17%, and this is a broad figure, I'm taking this from KPMG, 17% of the country's GDP, and it employs 40% of the country's, it contributes somewhere around 40%, divided between 34%, I think, in services and the rest in manufacturing. Now, this suggests to me a very strange juxtaposition where they're employing, I think Benny in her statement said that there's a lot of hidden unemployment here. So you can really start to crack the case open and see that, okay, there is a large, almost 50% of the employment is being generated through MSMEs, whereas the growth is not as high. Of course, during the last 2 years of the pandemic, we have seen a lull in the business. Also, this is not specific to MSMEs. Of course, this is specific to all developing countries, India in particular. And given the fact that even before 2020, our unemployment rates were sky high. Now, what I want to understand from both of you from a very purely business perspective is that given this continued sort of global low growth rate, and of course now there is a revival and all of that, and given that of course e-commerce has come up in a really big way during the pandemic, what are the peculiarities that you see in Indian markets that you don't really find in the rest of the world? That's one. And connected to this, where do you see at this stage where we are sort of transitioning out of the pandemic, hopefully, how do you see the e-commerce sector being part of the revival story, or is it just going to lead to more challenges? I would request both of you to perhaps keep it limited to 5 minutes or so that we can just cover more ground here. But again, let me come back to Benny. Benny, your thoughts on this?
Thanks, Shoini. So, to your first question, that what are the idiosyncrasies in the Indian setup? I think there are a bunch. I want to touch upon 2 or 3 here. The first is, I mentioned in my opening comments that e-commerce is great. And we'll also discover how great it is, I hope, in the couple of conversations that we have later. But by and large, it does give MSMEs a conduit to kind of interface with the user, cut out, hopefully, again, lots of caveats there, but cut out the costs of middlemen, so on and so forth. But I think the peculiarity here is that, there's only a very small bunch of MSMEs that e-commerce is able to serve. That's the first understanding that we need to have. So, for instance, I can give you an example. Global FMCG giants have machines that are made in India in the northern part of the country. Those machines themselves would be like, 50 million in INR, and the providers are still MSMEs, right? So there is that whole manufacturing MSMEs actually powering that manufacturing kind of disposition of India. So they are still very much the enablers of manufacturing in the country. That's one part of the problem which e-commerce will not be able to solve. There is the other part of problem that there are MSMEs that interface directly with consumers for whom e-commerce is great. Right. So if I have to focus just on the second category, the issues that these MSMEs face when they're trying to interface with the consumer via e-commerce platforms, then the first one is just the gap of credit supply, right? So we have some numbers, and MSME credit around the world is notorious. Most countries have a huge credit gap, and it's almost highest in the case of MSMEs because by their very nature, these are medium, small enterprises. They don't have a lot of collateral to show for, and therefore it's very hard for them to get credit. In India, the credit gap, I think the total credit given to MSMEs as per some recent numbers in 2021 was about 128 billion USDs. And the credit gap is almost twice of that. So that's the unmet credit demand. So the credit gap is estimated between USD 267 to 334 billion, while you're only giving out $128 billion in 2021, right? And this was the year of the pandemic. So I think first problem is that, and then when you actually unpack that problem of credit itself, a few things come out. The first is that when you don't get credit, what is it that you do? You fall in the trap of informal lending, inefficient capital, all of that. So to give some perspective there, only about 20% of Indian MSMEs have access to formal finance, and about 80% of us are reliant on informal capital, which is hugely inefficient. Then there are also gender gaps, right? So women take women's rejection. So women-led MSMEs face twice as much rejection rates as men faced as men-backed MSMEs. So that's one. The kind of turnaround time for loan application is much higher. So even if you have been accepted for a loan, your application has been accepted, you would not receive money immediately. What does that mean? What that means is that in e-commerce, where you need to have a certain kind of agility, where you need to respond to demand in real time, and you don't have as much ability to forecast what your demand is going to look like, the supply side can't be sclerotic. It can't have the inertia that it does have. But a lot of it is actually moving, the supply side is moving way slower simply because of the lack of agility in formal finance. So that's a huge gap, because e-commerce, you don't know what the next big rage is. You don't know where the demand is going to come from. Especially, I think the draft e-commerce policy tries to address some of this by kind of making an environment for better data sharing between the platform and the seller. But even then, the seller has a very small view of the demand from the platform, and they're not able to forecast it as much. So it's harder for them to address sudden spikes in demand, simply because credit is not as agile as demand is. So I think that's one bunch of the problem. The second bunch of the problem is just the lack of digitization. I spoke to you about this earlier. Unfortunately, we don't have very recent data. The last data that we have of this is from 2016-17, and that was the first of its kind. So the National Sample Survey Office in 2015, in the round of 2015, had a new module, and that module tried to look at the extent at which MSMEs are digitized in the country. Overall, the numbers for the country are really low. Only about 4% of MSMEs are digitized in the country right now, or at least were in 2015-16. I don't know how things have changed since. Right? What does that mean? What that means is, how do they find that platform, right? Because it's one thing that I'm not aware of, and maybe you and Lakshmi, between the two of you, there is some knowledge there. But as far as I know, there is no effort from e-commerce platforms to have staff on the field to go and identify where sellers are, or to onboard sellers to a digital I mean, I don't know if such a hand-holding exists, that can you migrate sellers from offline to online, or at least the scale or effectiveness of that level of migration, right? So there is a lot of people out there that are still out of the fold of digitization. However, just making them digitally active is not good enough, right? So then would they have the capabilities, even if the platform is giving out data? Do they have the APIs to fetch all of that data? Do they have intelligence at the back end to see what it means for their businesses, to extract intelligence out of it? So I think that's the second big challenge, that digitization and the lack of digitization in MSMEs means that they're not able to hop onto the e-commerce bus, as it were. And the third challenge is kind of peculiar to India. We're seeing the needle move on that, but I think it's still worth a mention. Penetration of e-commerce is quite high in tier 1. The pandemic has improved it for tier 2, but we go up to tier 6 in the country, right? So you're not even able to reach all the consumers out there. And I'm not even sure if that is a bad thing, because what that would mean, and this is an interesting kind of conflict and dilemma, right? The more reliance that we have on e-commerce platforms, the more local shops get shut. So there is that direct correlation between unemployment, and I don't know if displacement onto the platform is high enough to offset the unemployment that is caused all around. So I'm sure all of us have seen this during pandemic, that shops that we used to frequently go to have been shut down. A lot of their business has moved online. They don't find it worth the while. What makes it even peculiar in India is very high cost of real estate and rentals, right? So it's just not viable for someone to keep running a shop when footfall falls. So I think that's the other bit of conundrum that we need to solve for, that how much of e-commerce penetration do we really want? What are its effects on unemployment, and what is it doing to the local economy?
Thank you, Benny. So I think this is a really interesting point, because this is the kind of thinking that I've had on this issue, that there's a stark juxtaposition. So you can't, there is fantastic, expansion of e-commerce. And I find it very interesting that you say that, not a lot of MSMEs are actually on e-commerce platforms, because I was looking through the Amazon blog, and they have said that their aim is to get around 10 million MSMEs online, onto their platforms. On the other hand, you also tell us that, there's a problem of digitization, but we are a country with over 400 million internet users. There is 40% of employment that's going into MSMEs, but a lot of that employment is as you correctly pointed out, in the informal sector, which means no social protection, no formal wages, hire and fire as you want. The first line of defense and the first line to be cut off during a global health crisis, for instance. And of course, for certain sectors like garments particularly, you have the role of gender and stuff as well. Children involved in, for example, the firecrackers industry and so on and so forth. So really, we have to sort of peel the layers and see where is the employment coming from, who does the digitization affect. And I think for me, I completely agree with you. I think the peculiarities are that we have both benefits and cons attached to the sector. But I'm curious to hear what Lakshmi has to say, having a bit of personal experience as well. So I'm very curious to know, Lakshmi, what do you feel about this entire conundrum?
I think I'll rely a lot on the information that I have received from a personal level, but honestly speaking, I think I resonate a lot with what Benny was saying about the access to financial resources. And even if we were to consider that MSMEs have been able to get some sort of loans or some sort of a support from the banking system, I think the pandemic broke most of the aspect as well. I think that the most recent data that we have from the quarter of by the end of the quarter of March 2021 and by the end of the quarter of September 2021, I believe there was, a 14% to 15% of NPAs that were there from the MSME sector alone, and this is the data from the Government of India during the parliamentary session. So this is really concerning, considering the fact that I think I don't need data to say this, but of course MSMEs continue to be one of the biggest employers, the biggest employment generating body in terms of in our country. So yes, there is an inherent juxtaposition that exists, and more importantly, what I also find quite weird in the sense in these cases is that, well, banks are not very, recently correct me if I'm wrong, recently there might have been a change or a shift in attitudes, but banks are not very keen, or they're not open to providing such kind of loans, whereas they might be very happy in sort of providing those loans to say a higher performer. But MSMEs, despite the fact that MSMEs have higher aspects in stake, and the inherent structure of an MSME is such that they will obviously be better or more reliable customers in terms of giving back the loans, or in certain senses, or maybe even if the regulatory setup in general would have been slightly better for them, they will be very happy in returning those loans. But that doesn't really translate well in terms of banks' attitudes. Now, coming to the aspect of other sorts of regulatory challenges, while I do agree that yes, e-commerce might seem to be like this magic carpet of sorts. In fact, I was having this inherent struggle whether I should really use the term magic carpet for e-commerce in this context. But again, I agree with this aspect that yes, e-commerce still does not really take away the actual apprehensions that MSMEs tend to have, right? And this comes from a perspective of, I tried to put it from a perspective of a negotiation table, because that's just easier for me to understand from a legal perspective. But whenever there is any sort of a liaising that MSMEs do with the so-called big companies, particularly FMCG companies, what happens is that they find themselves to be on the weaker side of the negotiation table. Now, even if I were to juxtapose this, saying that, okay, fine, there will be no middlemen, e-commerce allows more accessibility. Even with that, it is very difficult to understand, especially with the kind of penetration we've had with e-commerce in our country, be it in terms of Amazon, Flipkart. These are all still big giant companies, right? And with that, I still don't feel that there has been any sort of a confidence building exercise that the MSMEs can go through for those apprehensions and those scars of the past to sort of be mitigated, and for them to be open to this kind of a change. One. And the other thing, I think I completely agree with Benny that there are certain times that there are certain kinds of MSMEs which will not be able to access e-commerce no matter what. And I think that also is something that I completely agree with. So those are my two ways. Yeah, that's it.
Yeah, I think I really resonate with you when you say that, like sort of in terms of actual access to credit. So let's get into the meat of the debate, which is the e-commerce, the technology question, right? And here are my brief thoughts about it. And you guys can, jump in and tell me if I'm right or, completely off the mark. One is when we look at e-commerce platforms, they are dominated by a few. It's not really a fair playing field. In fact, I was reading somewhere, that the CCI has recently, like the Competition Commission has, I think 2 days back, dismissed one of the trade association's cases against one of the popular shopping websites. And so you don't really have a rule of law that really supports your MSMEs. Okay, so that's one side. And I was curious to hear about that competition aspect as well. But irrespective of that, right, even if you say that, okay, MSMEs can access e-commerce, there's the other fact that both of you spoke about, which is a lack of access to credit. That even once you're on e-commerce platforms, it doesn't, what Lakshmi was pointing out, it doesn't really take away the structural inequities of the system. So I was reading 5 years back, the financing gap between MSCs and the other rest of the, of the industry was over $3 trillion, which is a huge amount for India. So there is a real inequity when we talk about it. And thirdly, even for businesses, for MSMEs that are on these platforms, they are struggling, I think, which both of you said, are struggling to keep up. I was looking at some interview of a restaurant owner who said, from a very, very popular restaurant owner, who said that, you see these bhel puri walas and you see these snack, options that would be earlier available before the pandemic on the roads. You see them on Swiggy or Zomato. And you probably think that, everybody's ordering and the business is doing much better. But in fact, the margins have peculiarly reduced on these platforms. So I was very curious about it. Why is it that the business is it suffering on e-commerce? Is these big tech giants that are controlling the market? Is it more democratizing? If I can put it simply, for all of these various insights I spoke about, is it more democratizing? Is it good? Or should we adopt a very sort of ring fence our MSME sector and say that let's say no to big tech and let's figure out what the structural problems are, let's solve that. I know it's a little bit of a controversial statement, but let me start this time with Lakshmi. Lakshmi, your thoughts on it.
I'm very happy that you use the term democratizing, because that makes my job a little easier in this context. So yes, e-commerce definitely provides, it's very easy to say that yes, e-commerce provides this sort of a platform, where everybody is equal. But that's a very romanticized concept, right? And we know this from our own experiences. And the way you said democratizing actually makes a lot more sense at this point, because the thing is, democracy is also has been criticized by many philosophers to be this sort of a tyranny of a majority. Right. So there is still one apprehension that I still have is, even if you were to keep the field open, and from a competition perspective as well, not just for e-commerce entities, but also from a perspective of the general, the sellers that are there in these e-commerce platforms, right? If you were to consider that aspect as well, all the brands, right, they are on the same platform. MSMEs are also on the same platform. With this, would we be able to sort of guarantee that there will not be antitrust issues, or there will not be competition law issues within that particular platform itself? Because if we were to consider e-commerce as a marketplace in itself, that is also one question that I don't believe the CCI has really answered or nobody has provided any sort of a policy reflection, as far as I know, but correct me if I'm wrong. But there hasn't been a policy reflection with that aspect, one. Number two, also the inherent e-commerce sector in which with which our country runs, there are so many players, and it's not something that's an easily penetrable market for them to become an e-commerce platform. It's not very easy, right? Practically, and this is not true only for e-commerce platforms. If I were to extend it across all sorts of internet intermediaries, the kind of market share that Google has, the kind of market share that Facebook or any social media intermediary has, and this is a time I believe government should take active mantle in ensuring not just that there are antitrust issues or any sort of a competition issue. I mean, there's more promotion of competition, but also from another perspective is to say that there should be better duties that should be imposed. Like, okay, fine, if this is how you want to steer the market, then let me have better duties on you, right? Especially with the kind of technology that they adopt. And there is also, I mean, of course, the intermediary rules that came out are kind of controversial with the consideration that, yes, there is a lot of duty that is placed on these intermediaries to try and almost filter off the content. While technologically that might be possible, because the technology is such that the law is following the technology. But even with that, I think there has to be a larger, that doesn't take away the fact that there is a larger duty upon these intermediaries that the government is supposed to enforce, to ensure that there is any sort of a, or there is some sort of a truer sense of democracy that is placed on these in these e-commerce marketplaces. I don't know if that really answered your question, but I'm sure it would steer the conversation for Benny to take this up probably.
No, Lakshmi, I think I really sort of resonate with the idea that perhaps this is not an MSME related problem only. And of course, we are seeing the evidence of that spill out all over. Of course, you know, we, with the context of e-commerce and MSMEs, we can perhaps look at flash sales and discounts and all of that. But Benny, to you particularly, I would like to tweak the question a little bit more, right? Because you come from an organization which looks at financing options, and you look at, you know, women, and you work so intimately with the community. In this context, can I really ask you directly to comment on, do you think it's e-commerce, particularly dominated by big tech, as Lakshmi pointed out, is it doing more harm than good? Or, you know, where do you stand on this? And if it's a larger question, should we zoom out of MSMEs and look at it from that aspect? I'd just like to point out to both of you that we have 15 minutes left. Perhaps after Benny, you are done, then we'll move on to some of the audience questions. Benny, all yours.
Yeah, so Shohini, that's a tough question, and there is no straight answer, right? It's a spectrum. I just want to point out what e-commerce is doing well and what it isn't, and we don't know which effect prevails or overwhelms the other, right? That's for us to analyze, understand, and then kind of have evidence-informed policy. So what e-commerce or generally platforms are doing well, right? And this is beyond e-commerce. These are ride-hailing platforms. These are food delivery platforms. These are shopping websites. So, I mean, just going back to the very theoretical definition of a platform, that it brings together at least two sides of a market, right? There could be like multiple, but it at least brings two sides of the market. In most of these cases, it's the supplier and the end consumer. So a restaurant and a person who's wanting to eat, a ride, driving a cab, and a person who's in the need of a lift, right? That kind of a thing. And what these platforms are able to do is, of course, they're able to kind of, they have an elasticity of scale that is impossible with manufacturing. So Uber, Ola could overnight expand, you know, in some sense, employment opportunities. I use that term very carefully, but they have the potential to get more people on scale, because technology is not limited in its scale as manufacturing is, right? So the fixed kind of, so there's a lot more elasticity, and I think that is something to be kept in mind. The second is, they are doing a great deal to invert information asymmetries. So we've spent a lot of time talking about access to credit being a problem. Now, what these platforms are doing is they are generating a lot of data on the partner's performance. And again, the question of ethics, the question of labor codes, contractualization, casualization, all of those remain. But in the very limited engagement, what platforms are able to do is they're able to generate a lot of data on the performance of the partner, the number of rides they're able to complete, the number of deliveries they're able to complete, the number of hours they're putting in, the kind of comments they're getting, which makes for a host of personal alternative information, which can be used to glean financial information. So for really long, banks, these income segments have been unfortunately invisible to banks, because they don't have a banking relationship in the sense that you and I do. They don't get a recurring income. They don't have a recurring FD. They don't have those instruments. Their lives are way more uncertain. Their incomes spike a lot. Their incomes ebb a lot. So there is all of that happening. So they don't have a formal banking financial history. But what is happening is, just by the virtue of being associated with a platform that is able to generate, collect, make sense of data, they are becoming visible to the formal financial system, and that is no mean feat. That is not something that can be dismissed or discounted, right? So Swiggy partners up with so many NBFCs to make loans available both to the restaurants and to the delivery partners. Similarly, Amazon partners up with banks and NBFCs to make loans available to their merchant sellers. And otherwise, if they were out in the open, in the absence of alternative data generated by the platform, in the absence of formal financial history for themselves, access to formal finance would have been very difficult for this group. So I think there is something to be said about how platforms are inverting information asymmetry, making credit visible to the system, and opening the pathways to formal financial services. So all of that is in the good, and we need to appreciate that, and we need to see how we can accentuate it further. Now, what is not working is, I think just the nature of the internet is not working. And I know I'm just like going really meta here, but we know how digitally native companies can grow bigger simply because they rely more on data, and then data has network effects. So then what that means is that companies grow larger, and as they grow larger, it is beneficial for everybody on the platform, right? So every new addition to the platform creates increases the marginal utility for all existing users as well. So it's not like users lose out when platforms become too big, right? So we have to kind of appreciate that that's how business in the internet or in the kind of digital ecosystem stratosphere works, and that perhaps growing big is in their nature, and therefore that can't be looked down upon or frowned at. What we need is to understand the features of that bigness and to make sure that we have safeguards to govern it, right? So for instance, if there is a dominant shopping platform, I being a small MSME, if I get onto them, I am actually harvesting their dominance. Their dominance is playing in my favor because now I am able to reach all the billion customers that they are reaching, right? So that's great news. The flip scenario is that if that dominant platform arbitrarily shuts me out, I am bearing a huge disproportionate brunt of their dominance, right? So I think what the EU is doing in that sense is commendable, understanding that some dominant platforms are actually gatekeepers to entire industries, and then governing them as such, governing them closer on the spectrum to an infrastructural utility as opposed to a private entity, and saying that you cannot be arbitrary, you cannot be discriminatory, you cannot, because one instance of arbitrariness at the end of the platform distorts the entire market, right? So competition law has to now start thinking about these gatekeeping entities in a more deliberate, intentional way. That's one part of it. But once you get into the platform, what's happening, right? Like Lakshmi said, there are, I mean, it's still not, the keel is still not even. And the reason it's not even is because there are costs associated with the platform itself. You want to advertise, there is keywording, there is all of that, right? People are able to put in more, are able to get more visibility. Some would say, what is so wrong with that? That happens in the traditional space as well. The more money you're able to put in advertisement, the more you're able to then, you have a higher outreach. I think what is wrong with that is the way data works and the way algorithms work, actually not so much data, but the way algorithms work, that they can quickly create a filter bubble. So you saw something on Amazon, I'm sorry I'm taking names, but this is a very generic example. You saw something on an e-commerce platform, you clicked on them, then you see that advertisement chasing you over Facebook, over Instagram, so on and so forth, even over just plain websites that you're opening after that. So there is multiple layers of advertising, buying and selling that is happening in the real time, and only those with that deep pockets can actually invest in those, right? So that speaks to Lakshmi's point, that who can guarantee that even bringing everyone on the platform would still be democratic enough, because there are all of these expenses associated with being on the platform. It's not costless. And then I think the third aspect that we need to be careful about is the platform a market participant itself? This was the recent case that the CCI dropped, right? So the unique position of the platform is that it has a 360-degree visibility of demand of the features that people are keying in, right? So for instance, 2 years back, it was very hard to find a refrigerator in India with kind of an ICE function within a particular price bracket. But because so many people have put in that keyword, that very string, that refrigerator with ice cubes under 30K, you have them now because the platform has the intelligence. And no surprise there that the platform is the provider of that refrigerator, because the platform knows where the gaps in demand are, or what are the goods that are being demanded. And therefore, they use that data, that intelligence to displace the very merchants who are creating that demand, right? So when the platform itself becomes a competitor for a merchant, that's where things get really tricky, because platform has advantage of information, platform has advantage of deep pockets, and that could really distort the market. So I think these are the kind of issues, and it's not like, therefore, let's ring fence, or therefore let's ban platforms. I don't think that's anybody's case. The case is that we have to understand these issues and then sharpen our regulatory tools in a way that we're able to address them. I'm sorry, I think I overshot 5.
No worries. No, but I completely understand. I mean, it's a very nuanced perspective. And of course, we can't, I mean, even if you do want to ring fence, I don't think we can. But we're almost at the end of the session. I'll end with one quick question. Perhaps you can take that question, both of you, and give us a 1 minute, concluding remark, because we do have to end it on time so that the next session can come on. So the question relates to the wider, conference theme, which is societal impact of commerce and sustainability. I want to focus on sustainability. Given that the country we are in, given the peculiarities we discussed, and the presence of these intervening sort of market forces, and the challenges that we have with informal networks and women and these kinds of data questions, what do you see in the future, in the near future? How do you see the industry itself, along with all the government regulations that are now coming in? It's a very uncertain policy time in the country, uncertain times anyway. If you want to leave our audiences, and there are many students, etc., who are sort of keyed in today, just a 1 minute quick concluding remark on where do you see this going in the next perhaps a year or two? Maybe Lakshmi, I'll start with you.
It's a very tough question now that I think about it, because there's so much, as I think we've already mentioned it, there's so much of, there's so much of unpredictability that exists in this current scenario, right? So of course, I am expecting a better data protection regime, at least. That's the most immediate, if I were to just sort of divide it in the short term and the long term. In the short term, I am expecting, since we've already gotten a joint parliamentary committee report on the data protection and the amount of changes that they're making, right. I'm expecting a data protection law soon, but how effective that data protection law might be is another question altogether, considering the kind of personal and non-personal data that questions they're playing up with. And what kind of a regime will that leave the e-commerce entities and the MSMEs to grapple with is something that remains a question in itself. So that is one thing I would like to point out. And in the long term, I think the pandemic should be a reflection point for the regulatory authorities to try and pick up the MSMEs in the truest sense and try and boost the industry. It's not. I would like to, again, it's a lot to do with my personal experiences, but again, yes, there are schemes like the Mudra loans and a couple of other schemes that they have come up with, which are slow steps. But we definitely need more and more such steps and more concrete steps in trying to grapple with what the industry is facing at this current point. And this has been something not related only to the pandemic. I think pandemic was the final nail in the coffin. It has been a problem for quite some time now. So I think formalization and probably going ahead more and more incentivizing the MSME sector is definitely a long-term goal that the regulatory authorities should definitely pursue.
Okay, thank you so much, Lakshmi. No, that was beautifully put. Benny, sorry, we have just 2 minutes, so maybe you can take a minute to just give us your thoughts about the future.
Apologies for this.
No worries. I'm so glad, because I don't have a good answer anyway. So I'll keep it short. I don't know where the industry is going, honestly. I don't know enough. But what I would like it to consider are three things. One is, of course, data protection. Second is a kind of re-examination of competition law. I think we have all the content in there, but we need some kind of a guidance to say that, this is not acceptable or this is acceptable. And generally a more kind of consultative relationship between the draft e-commerce or the e-commerce policy and Competition Commission of India. I think that's much needed. And the third thing that I'm hoping for is, and there are some signs that it will happen, is more, tailor-made financial solutions. So now increasingly all MSME lenders are wanting to understand how to target women. Right. So women's behavior is different than men's, and therefore the data points they generate is different. So how do you create an algorithm that is suitable for assessing women's credit worthiness? So I think these are the three things that I would like to see happen. Thanks.
Perfect. And we have 1 minute to spare. I mean, I would love to get into all of these. There are so many issues that both of you have pointed out. And that speaks to the wealth of knowledge that you brought to a 1-hour session. I know it was not enough, but thank you so much, Benny and Lakshmi. I know it's a working day for you to bring your sort of expertise of so many years to this table, not just for me, but for everyone who's attending. This is a fantastic session. I have so many notes written, and we are looking forward to hosting you again, and hopefully in person. Thank you so much for joining us.
Thank you. Thanks. Thank
you so much. Thank you, Shoini. Thank you, Benny. Thank you.
All right, welcome to session number 5 of the conference. My name is Ashish Bharadwaj. This is a keynote session. Our keynote speaker is Mr. Ajit Pai, a distinguished expert who heads the Economics and Finance Group and the Banking, Insurance, Financial Services Group at Niti Aayog, which, if you don't know, is the apex public policy think tank of the Government of India. His office is, of course, is in the heart of New Delhi, the capital, but not many may know, I got to know about this recently, that Seattle is second home for Ajit. And he spent several years for work, family, I believe for leisure purposes in the Pacific Northwest, the beautiful city of Seattle. On that note, let me change my background real quick while I introduce Ajit. So if you remember, Ajit, this is what you're I'll let you reminisce the skyline of Seattle and the mountain range while I will introduce you. Ajit Pai brings 3 dimensions to his work of providing directional and policy inputs. As the nodal officer for the most vital functions of the Government of India, he has an incredibly detailed Indian and international perspective on government economic policies, government finances. He coordinates with the important ministries of finance, Department of Economic Affairs, Department of Investment, Public Asset Management, G20 Group, World Bank, IFC, International Monetary Fund, and other multilateral agencies. That's one. Second dimension is that he's been involved with economic sectors in their nascent pre-funding stage. He's been involved in strategic transformations of organizations, their recapitalizations, and other important roles. In his role as a top-ranked investment professional, he has nurtured over 100 companies from early stages through their IPOs or other graceful exits. This makes him an ideal commentator, really, on how India can strengthen its own startup ecosystem, which the current government is very, very serious about. Lastly, and that's the third dimension of Ajit Pai, but certainly not the least, he is an architect trained at Yale. He's the current chair of the Delhi Urban Art Commission and a member of Indian Police Foundation. This makes him really a much more versatile, art-loving designer economist that are hard to find these days in this kind of multidisciplinary background. So there's much more to him than data, finances, and strategies. With that, I'll invite Mr. Ajit Pai from the Niti Aayog to deliver his keynote address, which is on the theme of the conference, Societal Impact of Commerce. Over to you, Ajit.
Well, thank you for that very, very kind introduction, Dr. Bhardwaj, and also, for giving me an opportunity to address this particular audience. Wonderful to catch academics that are focused on, studying both what has happened, what is happening, as well as figuring out how to make the future, a better place. So I'm going to begin by actually sharing some slides. Let me just get these. Can you see them? Absolutely. So fundamentally, when you're looking at the societal impact of commerce and looking at sustainability, technology, and society, I thought a great way to begin would be by looking at least in the recent past, the recent history of trade. So not a very long time period. Trade has been around and commerce has been around for a very, very long period of time. But just looking at the last 150 years. And right now, we are at a point at which things in the world seem fairly uncertain. But what you can see is that over a very long period of time, that trade has not moved in only one direction. And you can see that the time at which actually trade was challenged was also at a time that geopolitically, the world also was going through some tremendous stress. So while things might appear that things are fairly stressful, what we can say is that commerce is a great way to ensure that there's less friction around the world and actually quality of life improves very significantly for everyone that there is on this planet. So as we move and look at what world trade versus GDP per capita have been, we all know that population and demographics are a great sort of driver of economic growth. But looking at it on a GDP per capita basis, you can see that trade is a very material driver, highly correlated with the overall quality of life and GDP, per capita growth. So it is a very, very important, sort of de facto driver and de jure driver of what quality of life is and societal impact. So we shouldn't, be wondering whether it's true or not. Let's just assume that it is been a huge positive driver for the improving quality of life, and we'll go through some of the reasons why. But one very, very important thing to observe is that since 2007, 2008, the world is going through a plateau in trade, very similar or not too dissimilar to what happened between the two world wars. Going into the First World War and then exiting the second, we watched as a percentage of global GDP a decline in trade. And so it is in these periods where trade as a percent of GDP is actually following or is plateaued, where we have to look at all the societal good that's provided with trade and try and ensure that commerce is not a victim to some of the rising other pressures we feel geopolitically, because in the end, that sort of impacts all of us and creates challenges, I think, in terms of quality of life, and sees a deterioration in quality of life if we don't appropriately prioritize commerce. So very, very critical and very, very important. You'll also see that the big sort of drive over the past few hundred years, a couple of thousand years in global trade has been merchandise. And as a vast part of the global economy is also increased, merchandise has been increasing, but in the past like 30 or 40 years, we have seen the rise of services and global GDPs. The big factor to observe over here is that global trade in services is still fairly nascent. So, far overshadowed by merchandise. And this representation, I think, marks sort of the next leg of overall growth in commerce. Global commerce is going to be that of the penetration of services in commerce as much as it has been in GDPs around the world, where it dominates the OECD. In India also, which is very far from having the per capita income of the OECD, it is still now 60% of the overall economy. And I think improving trade within commerce, international commerce, will be very, very helpful for the next leg of growth for the world. So you can see that the overall share of both India as well as some other countries that are either neighboring or somewhat comparable in certain ways. You can see that India has done very well in recent times in improving its share relative to many others, but it's still not comparable with something like what China managed over a 30-year period if you look at from 1990 to 2020. And you can see that what has happened in terms of global per capita GDP as a percentage of the world average for the same sort of pool of countries. You can see that it is also tremendous. But countries like South Korea that have been much more trade oriented have actually done phenomenally well. But clearly countries like China, India, which are very populous, over 1 billion people compared to Korea's less than 50 million, it is easier for a smaller country to be much more trade focused than a very, very large country that is far more diversified. But this is just to place things into perspective and show that, with rising trade and, you can have some fairly significant improvement in per capita GDP. And, gradually, it is a very significant driver and can be a source of strategy for countries, more so for smaller rather than larger countries. But having looked at the success of China, driven by, trade in the 80s and 90s being commerce being a big driver of that, I think it's a model that, a country like India can still emulate. Looking more specifically at this conference and the topics. So I think we're looking at sustainability, we're looking at technology, and we're looking at social good, and commerce is a driver of those. And the way I would sort of look at it is that the sustainability would be an intention, for the commerce. I think technology would be an enabler, and social good is the outcome. And by definition, I think you've seen one of the most critical sort of definers of social good. If you're looking at the human development indicators, or if you're looking at per capita GDP, both of those are highly correlated. You can see that commerce is fundamentally a very, very good sort of driver of social good generally. Very broadly, improve commerce, which is fair, where there isn't too much sort of manipulation or distortion, It's a very good driver of social good. But now to accelerate commerce and to accelerate the social good, I think technology is a great enabler. And I think sustainability as a sort of one of the social goods, both in terms of sustainability of the growth, as well as sustainability in terms of the more conventional sense we use it on today, which is the Sustainable Development Goals in terms of environment consciousness and other sort of consciousness in terms of equity and things like that. I think that is a very worthy intention which this particular conference is focused on. So let's look at what some of those big benefits are. We have, of course, the fundamental driver of improvement and quality of life from commerce would come from cross-fertilization. Products, ideas, services from one part of the world going to a completely different part of the world creates massive cross-fertilization, opportunities for massive cross-fertilization. You also have, comparative advantage of certain regions. Certain regions are gifted with things that, might not be as valuable in their region as would be to other parts of the world. A great example would, of course, be in natural resources. Very few parts of the world have lithium, but very clearly it's becoming critical to many parts of the world in the climate transition. And historically, very few parts of the world had, fossil fuels. And the Middle East has lots of fossil fuels, but it's become critically important to other parts of the world. So trade is something that, would lend itself to comparative advantage. And then expertise and skills that are built up in certain areas, for the comparative advantage and comparative advantage, sort of both drivers where the world gets more efficiencies if certain parts of the world just helps out, growing things in areas where there's plenty of water and very good weather probably makes more sense than doing it in the most hostile environments where there's very little water. So these kind of changes are changes that would be required to be made. These advantages would be over there. Looking at maximizing efficiency and value to society, also I think you will see that when you use an area which has comparative advantage or comparative advantage, generally you have a consumer surplus that's created because it can do it at far lower cost and with much greater efficiency than other places. And that itself drives value to society that can use that same sort of consumer surplus that is generated to be spending on other things both domestically and internationally. So the value to society also, and efficiency are maximized. So commerce, it's very easy to see why it's such a great maximizer of the improvement of quality of life, as being able to help in achieving sustainability, as, how technology can be a great enabler, but also a driver of commerce and social good, of course, being that. This is a chart that I often refer to show, India, which is where I'm based right now, and as a driver of good. You can see that in 1960, India's per capita GDP as a percentage of the world average was about 18%, and it rose up all the way to 22% as of the world average in the post-independent India. But then, as India closed its economy to the world average, you saw that that India's per capita GDP as a percentage of world capita GDP declined quite significantly. So it fell all the way to mid-single digits. And after we started liberalizing, so it's not like the Indian economy shrank, it was actually growing right through this period. But what happened is that the world grew faster, and the world that embraced trade actually grew much faster than India. India was protectionist during this era. But post-liberalization, you can see that India has almost tripled its per capita GDP relative to the world average. And that's been a function of steadily improving trade. Now, when we look at what has happened in other countries, we can see that countries that embrace trade even further, for example, China, which has been a trade-driven economy, you can see from 1960 to the early 80s, it followed a very similar trajectory to India because it embraced trade much earlier. But then subsequently, you'll see that the trade actually started to accelerate its per capita GDP. So it overtook India somewhere sort of in the mid 80s after the Deng Xiaoping sort of new sort of way of looking at the economy. And then after that, you've had a steady acceleration of China, where today the most populous country of the world is actually approaching the world average in terms of per capita GDP. And a significant portion of that was by driving efficiencies and driving trade efficiencies through trade in the sort of 80s and 90s. And similarly, when you look at countries like Vietnam has used trade, it's a smaller country, 100 million people, but has used trade as a very significant driver of its own economy. And we have seen massive improvements from less than a third of India's per capita GDP to now a 50% premium. And when you look at South Korea also, less than 50 million people, so easier to use trade or commerce as the single biggest driver for the economy, but tremendous improvement in quality of life and per capita GDP based on how things based on their focus on trade. So now that brings us to what are the obstacles for India in terms of commerce, but also sort of the big sort of barriers to commerce, and those three factors that this conference is looking at. And very fundamentally, one of the big sort of barriers that we had in India towards commerce really taking off was the lack of formalization of the economy. So we looked at lack of formalization and said that if only like very low single digits as a percentage of the overall economy file taxes are part of the overall system, then the amount of visibility that both the government and the private sector have into actually what's going on in the economy is very, very limited. So 2 or 3, sort of transformational sort of efforts for the government of India that have happened in the past, 7-8 years have been both embracing the GST system, which is more than just the stick. We're also introducing the carrot. So getting rid of cascading and disparate taxes and sort of simplifying the system and making it more inviting for enterprises within India to join that system. So you can see the GST registration. This is the goods and services tax, which sort of is similar to the VAT in many, many countries and many economies. And you can see that this is something that has increased the sort of revenues of government modestly, but has sort of formalized the economy quite massively. So that gives much better sort of visibility into what's going on, as well as creates a track record for sort of accelerating private credit into the economy, which India has lagged behind most other countries, of similar size, in sort of helping accelerate both commerce as well as trade, as well as overall GDP growth. So you can see the formalization on the GST side, as well as Jan Dhan, Aadhaar, the JAM mobility. You can see that the number of tax returns as a percentage of the economy, as a percentage of the population, is more than doubled till today. Over here, of course, it's showing until fiscal year 19, but today during the COVID as well, the formalization has increased even more. And you can see that a very important part of sort of accelerating commerce and benefit to society has been the 430 million Aadhaar accounts, 450 million now, that have been added. And a Jan Dhan account is defined as an account that is of a household that did not have a bank account before in the entire household. So we had these 450 million new sort of people enter the formal banking system or financial system that were not there around 7-8 years ago. So tremendous amount of change, that has occurred over here that sort of is going to be an enabler for both private credit as well as for, accelerating formal commerce. The enablers for that, of course, for the JAM Trinity, the Jan Dhan, Aadhaar, and mobility have been the cumulative amount of identities that have been provided, helping formalize, the population. So you can see over 1.3 billion Aadhaars that have been created, unique identifiers for individuals. And you can also see the telecom in India, the true leapfrog to mobility, which triangulates this and makes the whole financial inclusion possible, as well as starts making that formalization far more useful. And that has resulted in tremendous acceleration in digitization and formalization, which is a huge enabler of commerce, as identities get formed, as people join the formal system, it accelerates electronic commerce, electronic transfers, RTGS, NEFT, credit cards, mobile-based payments, all accelerating. The other thing that we found that was a huge barrier to commerce in India and also would start accelerating the social good and technology has been a huge enabler is the regulatory and compliance burden and the complexity of doing business in India. So, over 70,000 compliances in this country, or almost 70,000, a lot of them at the central level, a lot of them at the state level, and a huge effort over the past 2 to 3 years in trying to reduce and simplify this. And technology is a massive enabler of this. I'm sure all of you would agree that's a massive social good. When you reduce the paperwork, we reduce the inefficiencies over here and try and allow things to happen faster, then automatically GDP will accelerate because the number of things that one has to do to get going are reduced, or even to shut things are reduced very significantly. So across multiple sectors, multiple categories, this has been a huge focus. It helps at the domestic level, of course, but what it also does is as you reduce this compliance and regulatory burden, much like formalization and credit that can be provided there, it also starts making the Indian enterprise, whether it's in manufacturing or whether it's in services, far more competitive at a global level. And eventually, commerce is driven and trade is driven by having a source of competitive advantage or comparative advantage. And as you make our enterprises more competitive globally, that's where it begins to accelerate commerce. And I think all of you, at least this audience, would know very well that both exports and imports are highly correlated. So as we become more competitive in our exports, we also will accelerate our imports, in balance, and things that this country does require outside of just the fossil fuels, but much more of other high-level things. So you can see all the required filings, broad categories, the sort of procedural sort of issues, working on simplifying all of those, as quickly as we possibly can. You can see some of the work that has been done for small, medium, and large sort of enterprises, what we were dealing with in 2019 and working on bringing those down. I think lots of progress has been made over here already, but more to be made. You can see across these different categories, how many compliances are there for each of these. And we can see that we have made some very, very broad, efforts in reducing these. You can also look at other sort of factors within the Indian economy that would make both our manufacturing and services enterprises far more competitive. You can look at electricity, costs that are very high in India relative to some of the competing countries. So working on these, we can look at some of the inefficiencies and cross-subsidization over here that we're looking at changing as well, which will make our enterprises. And very importantly, the scaling of our enterprises. So this is an area where if you looked across India, you would see that we've had a big focus on helping the MSME historically. But some of this has not kept pace with time. So globally, as enterprises and comparative scale of enterprises has increased very rapidly, you can see countries that have embraced that relative scale at a global level, looking at the global marketplace. China, for example, doing things at a global scale, has helped their enterprises become far more competitive. In India, our definitions of MSMEs hadn't changed very much over a long period of time. So an order of magnitude sort of change in the manner in which we define these MSMEs. So while we're supporting them, we're helping them transition from the micro to the small, from the small to the medium, and also from the medium to the large. So we're becoming more friendly towards helping Indian enterprises become globally more competitive by scale. So scale of enterprise has been something that we've been looking at doing that. Simplification of the labor codes that were impacted by scale previously, trying to simplify them so that this is not a huge barrier to enterprises scaling. And then a policy stand also, you'll see the one other link to make Indian enterprises far more globally competitive has been looking at logistics and looking at our, what they are in terms of cost and time. And this is where infrastructure and logistics is where we have looked at putting a lot of effort. The Gati Shakti program, the National Infrastructure Pipeline that was announced at the end of 2019. And then fundamentally, the financing part of both of these, getting enabled to accelerate it with the National Modernization Pipeline should be sort of including in all of these, trying to include the private sector far more, as we realize that the task ahead of us is so much. So, improving the participation and increasing the participation of the private enterprise within infrastructure will also bring much greater efficiencies, to the overall economy. So all of these also, I think, we're trying to boost, especially the scale of enterprise, by looking at boosting manufacturing through the production-linked incentive scheme. You're looking at, fundamentally, many different sectors that are going to be addressed over there, and I'll touch upon them very briefly shortly. But you can see where the sort of Gati Shakti is the National Master Plan for Multimodal Connectivity. Historically, we've already talked about the National Infrastructure Pipeline, which is a massive sort of effort, 111 lakh crores for upgrading the infrastructure of this country over 5 years. But what tends to happen is we tend to do it in a siloed way. The roadway separately, railway separately, aviation separately, the seaway separately, port separately. But what Gati Shakti does is it improves the overall visibility into how we can coordinate these better. So any money that is spent over there, whether by the center, by the state, or whether by various departments and ministries, are done in a coordinated fashion. So they start helping each other and feeding off each other, are symbiotic and synergistic, far more closely. And, the right industry parks come in the right place, closer to where logistics is going to be coming, whether both rail, road, and, aviation, all of that happening at the same time. So this kind of multimodal connectivity is enabled far more efficiently if each ministry has visibility in what's going on in other places. And I think Gati Shakti is going to be providing a lot of this. So you can also see in the National Infrastructure Pipeline, where we have broken it up into various sectors, that for the first time we are actually including the private sector as part of that plan at 21% of that overall spend intended, which is massive. Historically, it's been driven at the state level within India, and now we are increasing the contribution by the center quite a bit. And the dependence on just the state is going to become less, with the private sector and center stepping up much more. The National Monetization Pipeline, stabilized assets in India that are more efficiently now run by the private sector, which don't have the project risk that takes the cost of capital extremely high and sort of reduces that deployment. So shifting these stabilized assets to the private sector, which are, will be able to manage it more efficiently, but brings down the cost of capital, because the project risk and deployment risk, which is higher in India, is taken care of or is, by the government. But once the asset is created, then it can be shifted to the private sector for a period of time on concessions. And then the PLI that we talked about, the largest program of its kind, it's going to take time for a lot of this compliance and regulatory burden to come down. As we've made huge progress, more to be made. It will take time for the national infrastructure, pipeline for the logistics and infrastructure of this country to improve. We have made huge strides, but more to be made. But the transitions as the world moves to de-risk themselves from China, or a single economy having too, significant a portion of the global economy, 60% in certain very core critical building blocks of the global economy. If you look at steel production globally, you look at aluminum production, you look at API production for the pharmaceutical sector, that kind of risk was so high that as countries look and multinational corporations look to diversify that risk that has been exposed in the middle of this pandemic, the amount of risk that the world has, and they look to diversify that. When the diversification is happening, the Indian government has said, okay, I know that we're not the most efficient in these areas, making progress, but in the meantime, we can help you reach critical mass in India. So it's agnostic to whether it's a foreign investor that produces in India or a domestic investor. We want to make enterprise in India more competitive, and we are willing to pay based on the amount of production that you do in India over this time frame across these 14 sectors. You're willing to, subsidize that difference in competitiveness you have today for that 5-year period until it takes for India to truly become competitive here. And we've been making huge strides over there. So these are the sectors across which we've had, announcements already. Tremendous progress on 3 of them. You can see in mobile and electronic components, in pharma and in medical devices, you've made good progress already. In the others, you're making also very, very, good progress over there. So I'll stop over there. I know it's a lot of material I've gone through. but looking at how India and Indian enterprises can help out in continuing the rise of commerce in the global economy by diversifying the very significant risk that is there in the global economy, the steps that India is taking to ensure that India participates in the next leg of growth over there. And with that, back over to you, Ashish, open to any questions that you or your audience might have.
Thank you so much for that tour de force of where the Indian economy stands and how we have evolved and the kind of potential that we are seeing going forward. There is a lot of interesting and new ideas, a lot of ambitious ideas that have been unveiled and implemented by the government, and time will tell how much we are able to extract out of them, but it looks quite promising. There are a number of questions that have already come in. I'm going to start moderator privileges. I'm going to start with the one that I found the most interesting. And for the audience, students in particular, I'll try to contextualize some of them that may seem vague initially. So just before COVID struck, economists were trying to understand the 10 years since the 2009 financial crisis, and data after a certain exogenous event happens becomes fertile ground for all kinds of research, basically figuring out reasons of short-lived rebounds, reasons for a largely weak growth in emerging markets, some periods of slow growth in India as well, despite several rounds of fiscal stimulus. I'm talking about the previous decade. Now, my reading suggests that a consensus emerged among academics who undertook this exercise of understanding the post-financial crisis developments, is that emerging markets, developing countries became more vulnerable to economic shocks in the previous decade. Now, here's the question. With India and the world now gradually coming out of the long pandemic-induced slowdown, economists and several academicians outside economics also are going to be taking a comprehensive stock taking of what's coming up in this decade now, post-pandemic. So my first question is, what advice can you offer to researchers, economists who are working in universities, even in other government bodies, who may want to take up this challenge now in this new decade? How do we look at the economic impact of the pandemic? It could be India-specific analysis or something slightly wider. How would you go about doing it?
So I think that's a great perspective and also a great question. But let me first begin by sort of giving you a little bit of context as to the other side of my job, right? So there's the economics and then there's the finance. And the moment we have a look at some of the slowdown that has occurred, I'd like to point out that the heart of that period of slowdown, where global trade actually started plateauing as a percent of GDP, that emerging markets started to become more vulnerable, was driven by the world financial crisis. So the decade that you mentioned too is actually slightly longer than a decade. It's about 15 years now since the world financial crisis, 14 years now, if you look at 2008 or look at 2007. And what the world financial crisis actually was symptomatic of, as an early symptom, was of the rising debt in the world. So if you go back and you look at from 1980 onwards, you'd see and you quantify the rate of increase of GDP and the rate of increase of debt, you'll see that the vast majority of the increase in global GDP was driven by global debt. So it was the financing, or the debt financing of the global economy that was responsible for 2/3 of that growth. So that is something that we need, I think, more work on for, I think, economists and people, that are looking at the global economy to see what the causality for that growth even prior to the world financial crisis was. And very interestingly, even though the crisis was created by financing and high debt at that point of time and somewhat irresponsible financing of debt, what has actually happened subsequent to the world financial crisis is that the debt to GDP of the world has actually exploded subsequently. So it's even risen further, not gone down. So what we have done is we know the symptom, we are able to identify the disease, but rather than double back, what we have done is we've actually made debt far more prominent, which means that we are closer to the end of a long cycle rather than the beginning. So one of the areas that I encourage researchers to look at is what is the various ways that we can get out of this unprecedented period of the highest ever debt to GDP for the globe ever. So, that itself leads to, unsustainability, because, we can't grow at that pace anymore of debt to GDP rising further at this level. Or if we can, how much further? The second is we'd have to look at the impact that happens when countries are taking on more debt in a period of very high debt, for the stimulus that you talked about, the stimulus that many countries have had. What is it generally tied to? And you'll see that the political economy across the world is whenever you're indebting a nation, you're trying to focus on domestic businesses. So whether the US has become more protectionist, is the cause actually the stimulus that they're providing? Would they want Americans to be spending more, to be spending on overseas economies in a global world where there's lots of trade? Or would you be saying that, okay, if you're taking from the taxpayers of the US, you'd want to be encouraging American businesses? So similarly, you'll find similarly phrased exercises, mainly because of the political economy at a global level, not just in India, not just in the US, not Atmanirbhar, all of that. But the fact is that when you're going to be doing the stimulus, which is unsustainable, the responsibility is to the domestic. So a lot of research is to go into showing that the benefits of commerce, the societal good, are not by withdrawing from global trade, but by actually accelerating global trade, honing it more on relative advantages, and figuring out a way, whether it's inflating our way out of this debt in the most indebted country in the world, the largest country, which is also the reserve currency of the world, or in other sort of situations, because even though the euro is not necessarily the reserve currency of the world or as prevalent as the dollar, they also have a problem of very, very high debt. So these are some areas that I'd look at where the impact on the emerging economies has been, largely and to a great extent, driven by sort of what I would say protectionist measures or domestic stimulus driven by political economies of various countries. So we have to see that.
All right. Thank you very much. That makes it easy for me to contextualize the next question. And it's about the GST collections, the data that you showed in your slides. And it seems that while the GST collections were kind of stagnating before COVID struck, currently they're not probably performing as well as they're expected to. Well, it's predominantly because of COVID, but also direct income tax compliance becoming an additional challenge. How do you think, Ajit, the government should undertake, since you talked about debt just now, how should the government undertake fiscal consolidation now at this point in time in the Indian economy, as we currently are well over the fiscal deficit mark that is set under the FRBM? So actually, I'm throwing the same question.
Ashish, I'm looking at the data, and I think your comment that the GST has been slower than otherwise because of the economy or the pandemic. I actually think that that's not necessarily accurate, because if you have a look at the GST and you look at the buoyancy in both direct and indirect taxes through the pandemic, you will notice that only the first 6 months of the pandemic, you actually had a material dip. And subsequently, even if you look at the most recent year, the one that we are yet to complete at the end of this month, fiscal year, you'll see that the buoyancy has been tremendous. At the same point in the economy for both direct and indirect taxes, it's much, much greater collections than previously. And I think a lot of that is to do with the increased formalization of the system. It's been tremendous formalization that's occurred. I think some of the muting that you might think that would have otherwise occurred in the GST might be because the GST Council over the past 3 to 4 years also reduced tax rates, GST rates across many, many key items. So if you overall have a look at our direct tax collections, you have a look at the indirect tax collections, I think the surprises have been on the upward side for the past year. In fact, very significantly so. So overall, I think that the strategy of formalization of the Indian economy has been one that has been yielding a lot of benefits, despite lower tax rates across the board, whether you're looking at corporate tax, you're looking at personal income tax, you're even looking at customs duty. Believe it or not, despite all the talk of protectionism, You're going to see as a percentage of tax collections, as percent of GDP, that customs rates these past couple of years, customs collections are the lowest that they've ever been in history. So I think that overall rationalization of tax rate, formalization of the economy has been having very significant benefits. And I actually think that those will continue. But the second part of your question, which is how far are we from the FRBM? I think that is something that is a greater cause for concern. And that is a cause for concern because if you have a look at India's credit, the total debt to GDP, you'll see that the government debt to GDP is very high, but the private credit is very low relative to other economies. It's one of the lowest in the G20. And to increase this private credit to accelerate the economy, like China did over the past couple of decades, like a lot of the other Asian economies have done, requires two factors. One, of course, is the formalization that we have taken care of. We have GST, you have all these Jindal accounts, all of that, which is creating all this data so that we'll have more reliable lending, a greater percentage of the economy becomes eligible for borrowing. But the second is we have to bring down the cost of capital. And the cost of capital is generally benchmarked to the sovereign, where India's cost of capital is almost double that of China or even Vietnam, right? So we are at like 6.7 on the 10-year G-Sec. And that is sensitive to the fiscal. So that is sensitive to how we look at it. So strategically, we have got to look at figuring out the manner in which we can actually reduce the government debt to GDP, which requires to be more conservative there. And one strategy that could be deployed is by accelerating private participation in the economy and the infrastructure that we talked about, where if the private credit rise is what's driving GDP growth, then it'll prolong the cycle because that will actually, bring down the government debt to GDP ratio. GDP growth is being driven primarily by the rise in private credit. So I think that is one strategy that we could deploy. And I think that will also gradually start, almost 50% of government expenses are interest payments. So as that helps, we'll be able to remove some of the fiscal pressure that comes from interest servicing and debt servicing. So that's one strategy. There are others that I could talk about, but maybe you have other questions that,
Yes, I do. Thank you. And let's hope the strategy works and we don't have to resort to a second one. We're running out of time. We have 8-10 minutes. I'm going to get to certain specific questions that are now coming up. They are sector specific. I'm going to start. The first one is on the power sector. One of your slides talked about market distortions in the power sector. With electricity bills, power costs are actually expected to become the next casualty of the ongoing war. So presently, the reality is that India's most ultra-critical thermal plants, power plants, are dependent on imported coal, which, as everyone knows, has become more expensive now. It became more expensive even last year. So the question is this prolonged dependency? You talked about the infrastructure sector. A lot of it is going to be powered by literally availability of coal and the vibrancy of the power sector. Is the prolonged dependence on this back-breaking coal imports India's Achilles heel? How do we fix that?
So I think that's a great point, great question. And I think part of that is getting answered by India's focus that was announced at COP26 by the Prime Minister on achieving our SDG goals and also our sort of net zero commitment by 2070. So a large part of the reallocation of our central government and state government and even local government resources is going to go towards shifting our energy mix away from coal. Now, that doesn't mean that today coal is any less relevant to the economy than you suggested. It is very relevant. So driving utilization over there in the short run of improving internal logistics, ensuring production at Coal India, all the existing capacity is utilized to its maximum are things that we are working on. An interesting observation in July, August of 2020 was that the coal movement had accelerated so much that utilization in many plants could actually go up quite a bit because passenger trains weren't moving on the railway lines because we had the capacity to move. So we've been in a capacity constrained environment in terms of transportation of coals, all of that. So to your point, the coastal plants are dependent on foreign coal to a great extent. Also, of course, the different content of ash within that coal. But what we are seeing now is with this increasing investment in infrastructure, some of those bottlenecks are easing in the short run. And as we go forward, while our dependence in terms of absolute level of coal is not changing and our production is changing. It's changing at a much slower pace than it would have otherwise, with our big focus on, that has already been announced towards these transitions towards not just renewable energy, but also clean energy of other sorts. We're talking about hydrogen. We are talking about gas, a lot of these transitions. You are going to see that coal as a percentage of the energy mix, and even more importantly, as a percentage of the economy, is going to become much less relevant.
Right. Thanks very much. I have to ask, there is a lot of comments and questions coming around the NMP, the National Monetization Pipeline. For the uninitiated, it was unveiled by the Government of India about 8 months ago, in the month of August last year. It's a ambitious project, and I've been reading that it is on to a very good start. But a lot of students want to know from you, what is the status of the NMP right now? You've given certain figures in your slides, but I'll expand to that question and add that what more can we do to increase the effectiveness of public capital in India? After all, the targets that we have to meet in the next year, the 2022-23 fiscal, is double now. Instead of 0.8 trillion rupees, now we have to hit the mark of 1.6. So are we on track? How are we doing? What are your views?
So let's put it this way, that the national monetization pipeline has two sort of broad benefits. One, of course, is that it has fiscal impact. It has the number, attached to it in terms of helping meet the infrastructure deployment requirements and the financing of that. The second is it brings efficiencies to the overall economy, by shifting something that is within the public sector to the private sector with the efficiencies that brings. So when you have a look, the fundamental thinking of the national monetization pipeline, when you look at the numbers involved, it is a small fraction of the national infrastructure pipeline. So it is a very, very modest and very small, number that is out over there. But what it does do is it starts providing a menu for anyone that is interested in these areas to come, and it starts creating a pipeline beyond this as well. Because what it's doing right now is, in an area where things hadn't happened, there was no precedence. You are beginning to watch us start creating capacity in terms of making things, viable options. So, 2 or 3 years ago, REITs, InvITs were not options in India. You had 1 or 2. Today, you have over half a dozen. You have many more coming. So the menu has been expanding very, very steadily. We are creating capacity and actually execution. So this initial national monetization pipeline, while those numbers are there, those various sectors are there, by no means was it to be considered exhaustive, and by no means was it considered to be that this is exactly what's going to happen. It's considered to exactly like the national infrastructure pipeline. It's to take a stab for the first time in quantifying certain goals, certain areas, and like with any forecast of a public corporation, you're going to win some and you're going to lose some. You're going to be ahead of track on certain areas which are easier to flow, where you don't meet sort of unforeseen or unprecedented blockages, and so you move faster. And in other areas where things happen, you have interruption that might move slow. Overall, I would say that the government and the Niti Aayog have been very pleased with the level of involvement and engagement of the ministries and the public sector enterprises that have been involved in the NMP. And the enthusiasm is much higher than for strategic disinvestment, which is privatization outright, because I think the belief in the system is that these assets will come back to the government at the end of the concession period, would have been run efficiently. And it's not selling the jewels. It's like still keeping them with you, except you're giving it to someone. It's like outsourcing for a period of time and it'll come back.
Thank you. I must ask, since you mentioned that it's being received well by the ministries and they're responding quite well to it. Let me talk about Indian Railways here, one of the ministries. And Railways accounts for probably 1/4 of the NMP target in its first leg. And it is rightly so expected to be a very important avenue for long-term wealth creation. Was the ministry or the Niti Aayog surprised that railways received a cold response from the private sector, with perhaps only one bid placed so far? Or it was anticipated and in the second phase, more is expected?
So I'm not sure what you're specifically referring to in the railways NMP program, the one bit that you're referring to. Can you be more specific in that question?
I mean, the people have been tracking the developments in the Indian Railways and the entire industry. The concern is that while the rail lines are overutilized, the most important ones, because they are kind of plugging the most important gap and need, there seems to be a concern around pendency of project, which is persisting. Now, it has its own challenges, I understand. That may have impacted the final absolute number of bids coming in from the private sector as part of the NMP scheme. Is that a concern?
So I think when we look at the NMP, it is much broader than what would be one bid for if you're referring to private trains or something like that. So you're looking at various categories that are getting part of that program. For example, you have a whole host of railway stations that are going to be part of the monetization, where there's tremendous progress that is being made. There are various elements of the railways program that are out there. They are specific. Generally, when you look at market discovery in a new area, you might not have the terms right in one particular specific kind of transaction. It might have to be made more attractive, less attractive. Might not be the number of bidders, potential bidders that would qualify, not qualify. So all of those are very specific. But very broadly, I would say that the railways is likely to prove over the next 5 years as one of the most significant contributors to the NMP, as you've rightly said. But the number of categories is very, very many. And the PPP, which is a model of public-private partnership, when you have a landowner that is as big as the railways, the number of opportunities are tremendous. So it's not just specific operations of certain specific areas that matter. It's also an overall strategy that when we have started embracing, that we shouldn't read one particular bid in one particular area into the overall potential success and embracing of the railways. And the market appetite for what the railways has, because the market appetite might not be for one particular segment, but the market appetite for land and for logistics of the railways, all of that is extremely high.
Right. I think the focus of the question was more on the mail and express trains, where it was more of a tepid response. But you're right, it's one of many categories within this sector. Ajit, it's 12:52. Do you have time for another question?
I will have to leave now.
Okay. All right.
Right.
All right. Okay. So thank you so much for your time. It's a working day, I know, but it's always a pleasure to talk to you. You've been generous with your time in attending our events. Thank you so much on behalf of OP Jindal Global University and Seattle University, our partner institution for this conference.
So thanks for giving me an opportunity. It was delightful. Thank you for the great questions and all the best.
Thank you.